Good morning, everybody. Hello. Good morning, everyone. Welcome to the Innovation Loans briefing event. Welcome to everybody online. I hope you've all got your connectivity sorted, and if you're online, I hope you're sitting in shorts and t-shirts with a fan, because we're actually quite nicely air-conditioned here, which is good. Not as good as Sainsbury's, where I was yesterday afternoon after a really hot and sweaty briefing event in Brighton. Welcome. The basic housekeeping. We're not expecting any fire alarms, so if the alarm should go off, please follow the emergency signs. I'm sure there will be professional people who will tell us exactly what to do and meet somewhere upstairs that's safe. Loos are out to these rooms, turn left and go all the way along past the other meeting rooms, and there's ladies and gents there. I think those are the only housekeeping events. Hopefully you're all hooked up to the Wi-Fi. If you wish to tweet, it's hashtag Innovation Loans, and Russell's way ahead of me here. Here's the password for the Wi-Fi so that you can get online and connect, and if it's getting really boring, then you can be doing emails. Scott, my colleague Scott, will definitely be doing emails. But hopefully it will be absolutely riveting, and you won't be distracted by that. Okay, so what are we going to do today? We're going to talk about innovation loans and our current innovation loans competition. To brief you on that, not a typical Innovate UK briefing event, in that we're not just going to read out the instructions. Hopefully we'll try and interest you, and in particular, after I've given you the introduction and talked about the features and the benefits of the product, and giving you some thoughts as to whether it might be suitable for you, we have a panel discussion. I was hoping to have 4 existing borrowers. One unfortunately had to drop out at the last minute because their daughter's not well, but we've got 3 companies who are existing borrowers on the Innovation Loans Programme to talk about their experiences, and we've got Rod Beer from the UK Business Angels Association to moderate that panel. Sorry, Rod, I should have told you that there was 3 rather than 4, but now you know. Then we'll have a break for some coffee. Then we have Ian Tracy from the Knowledge Transfer Network, who's going to give you some hints and tips on how to write a compelling application in relation to the project that you might propose to us. Again, instead of reading out the instructions, Ian's going to give you some hints and tips on how to do that well. Then we're going to have a little chat about the business application side of things. We've got folks here from Early Metrics who we're working with this time round, who are collecting information via a survey. And then Scott O'Brien, my colleague, is going to talk about our approach to credit. And then I'll wrap up, and hopefully we won't be too late for lunch between 1 and 2, and hopefully some networking before you go out and find ice cream or whatever you want to do, because it's a nice sunny day. For those online, if you have questions, please fire them through. We won't be taking questions during the presentations and discussions. We'll save them up for the end of each panel and presentation, and Emily from our team will be moderating the online discussion, so hopefully your question will be answered, and we'll see how it goes. So please read the instructions. If you are thinking of applying for an innovation loan, and I hope you will decide that it's suitable for your business and is going to help you grow, please read the instructions. Go to the competition brief. That tells you the formal, what this is all about. Please read the guidance. Those are the instructions, the boring, nitty-gritty, but we are quite boring at Innovate UK, and we like people to do things properly. We don't like having to say things are applications are ineligible because you haven't followed the instructions. So please do read those. They're great fun for me to write. So hopefully it'll be even more fun if I know that you've read them as well. And there's general guidance, there's specific guidance. And if you're not clear about something, please contact our help desk. Our customer support service team in Swindon really like getting calls about and emails about innovation loans, because they're much more fun than the regular day-to-day stuff around Innovate UK's grants. They just say that to keep me happy. But what they will do is hunt me down so that I will respond, or the relevant person will respond within a couple of days. So yeah, contact me on Twitter or LinkedIn if you wish, or send me a direct email or try and leave me a voicemail. But if you go through the customer support service team, you're going to get a better quality of response and your certainty of response, because I tend to react to their emails because they hunt me down and chase me. Whereas if you send me a LinkedIn message, I'm quite good at forgetting those. But we do want to respond to questions, and if anything's not entirely clear, contact us. We will do our very best to answer. We can't give you advice, but we can try and offer you guidance that will help you in your application. So I'm Nigel Walker, Head of Innovation Lending at Innovate UK, one of the directors of Innovate UK Loans Limited. And yeah, going to talk about innovation loans. So Innovate UK, who doesn't know about Innovate UK? Who doesn't know who we are? Cool. I always love it when there's one person in the room, because I can then have an excuse just to carry on with my slides anyway, because I was going to carry on with these slides anyway. So Innovate UK, we're the UK's innovation agency. Our role is to stimulate business-led innovation, because that drives productivity, that drives growth in the economy, and that's what it's all about. Innovation loans are one of the mechanisms that we have to drive that growth in the economy. And we're doing it not because we want to fix the gaps in the banking market for smaller businesses. The British Business Bank has fantastic programs to help the market overall. Our focus is on innovation, because innovation will drive economic growth, and we're providing some support in that in order to help your business grow. And we do it for impact. So yeah, it's very nice for us to be able to say, oh, we've invested £2.5 billion of taxpayers' money over the past 10 years or so, and that has created 70,000 jobs. The whole point is that your businesses are creating those jobs. Your businesses are creating the impact, the increased turnover, the more taxes that you pay, the more people that you employ. That's what increases the gross value add in the economy, so that for every pound of taxpayer support that's provided, there's up to £6 to £7 of increasing gross value add to the economy. And innovation loans are part of that. They're a mechanism to do that, but doing it in a way that has benefits for you, we believe, and hope that you will agree, and also makes public sector funding work harder and go further. This slide it tries to position where innovation loans fit, but before this slide talking about how we fund, I should of course mention that one of the key things we do is not fund. We connect people. So through the Knowledge Transfer Network, and I'm pleased we've got Ian Tracy here today from the Knowledge Transfer Network. We've got the Enterprise Europe Network, and also the Catapult Centres. So connecting those people is really important, and funding is important as well. And typically the way we fund is in one of two ways. One way is through identifying, on behalf of government, working with government, the government's industrial strategy, delivering the Industrial Strategy Challenge Fund. And that's all about major, significant societal and economic challenges, which also represent, for you entrepreneurs, significant business opportunities. Very much focused around collaboration, because these are big challenges, big shifts in industry, in the economy, creating whole new industries, and collaboration is a great way to do that. The timing doesn't always work for all businesses though, and the scope of those challenges don't work for all businesses, and therefore we also have a responsive programme, which used to be called the Smart Grant Programme, was then called the Open Competition, and is now called Smart again. I have very few jokes, and it's really nice to get that little ripple of chuckle when one of my not very good jokes actually almost works. So Smart Grants are there, open to any sector, any challenge, any technology, at a timing that works for you. They're highly competitive, but a great mechanism if you're looking to find and prove a new idea. If you're looking to scale and grow your business, particularly for later stage research and development, then we believe that innovation loans are a good way to do that. And we're running this as a pilot program to see whether indeed it does work, to gather evidence so that once we know who the future government's going to be, a new chancellor, new business secretary probably, there'll be a spending review at some point in the future, we want to be in a position to put in front of those people a compelling case that says that innovation loans really drive growth in the economy and benefit businesses. So we've been running this as a pilot program. It was originally announced back in 2017 in the spending review by George Osborne. I think back to those times. It seems a long, long time ago. And the idea was, when it was first announced, that we would have £255 million over a spending review period, leading to £165 million a year of innovation finance, including innovation loans, from 2020. So, of course, once it had gone from announcement in the spending review through to actual implementation, we had a £50 million pilot programme to see whether something as scary as the government, through Innovate UK, lending money to businesses for growth through innovation, see whether it would actually work. We've run 5 competitions, and I'll talk bit in a second about the results of those. We've committed £50 million, and we've found some, our friends in UK Research and Innovation, of which Innovate UK is a part, found some money down the back of the sofa. We've got approval to extend the pilot to run 2 more competitions. We've got another £25 million available this year to run 2 competitions. And we're tinkering a bit because it's a pilot. We're looking to learn more, and I'll talk a bit more about that. And the whole point is that it's about stimulating business-led innovation, helping later stage R&D to happen in small businesses, doing projects with a clear route to commercial success through offering loan funding. And this is what the innovation loans are. So it's for single company applicants. We're lending to 1 business at a time. We think it's right for small and medium-sized enterprises only. We don't think that big businesses need this. The interest rate is below market. In this extension of the pilot, the interest rate is 7.4%, but back-ended, and I'll explain that in a second. In the original pilot, it was 3.7%. We're looking to understand what some of the drivers of demand for innovation loans might be, because this is a pilot. We can lend for as long as 10 years. We haven't actually lent any 10-year facilities. I think the longest that we've done is 9.5 years, and on average, our loans are about 7 years in duration. And the loan size can be between £100,000 and £1 million. On average, borrowers in our pilot programme have borrowed about £700,000. And of course, arithmetic means are typically meaningless when there's a wide distribution. So most people have borrowed about £1 million or so, and a few people have borrowed around about sort of 200, 250,000, 300,000 pounds. So the average is about £700,000. And the key thing with innovation loans is that they can fund up to 100% of the eligible project costs of a later stage research and development project. You can get a grant for a later stage research and development project, and if it's experimental development, you could get free money from Innovate UK through SMART, for example, and you would get funding of up to 45% of your eligible project costs. With a loan, you could get up to 100% of those eligible costs funded through the loan, and in return, you pay some interest and you repay the loan. So we're looking for growth-oriented businesses that see that as a benefit. And we're specifically focused on later stage R&D. We think that grant funding is fantastic for collaboration. We think that grant funding is fantastic if you're looking to find and prove a new idea. But if you're looking to scale and grow your business and really get into the market through innovation, then we think that, and we hope that, an innovation loan will be the sort of thing that you would want to use. And what I hope that you will do when you're thinking about an innovation loan is think about your technology development strategy, where you are. Think about your scaling strategy, whether it be manufacturing scaling or putting in place a platform in order to deliver software as a service, for example. I hope you're thinking about your commercialization strategy, how you're going to get to market, and then think about your funding strategy. Should you just be putting the money in and getting the R&D tax relief? Should you be funding it through, should you be bootstrapping? Should you be taking on equity investment? Should you be going out and borrowing in the market? And if it's challenging for you to do that, because of the nature of the R&D that you're doing, then maybe an innovation loan might fit as part of that funding strategy. And whilst we're here effectively today on a sales pitch, what I'd really hope that you do is consider this as one of the many options that might be available to you to consider how best to have a funding strategy that enables your technology strategy to turn into a commercialization strategy that will help your business to scale and grow. So this is what innovation loans are about. As I said, it's for small and medium-sized enterprises only. We want really innovative projects. We want to take risk on technology, on innovation. It's not for the run-of-the-mill stuff. This is for things that are stupidly risky to do. We want growth-oriented businesses. So I can talk pejoratively about businesses that maybe make a living out of consulting, that maybe just take the money over and over again in grants, and we could politely call them frequent flyers. I might rudely call them grant junkies. This is really for businesses that are growth-oriented, because you're going to have to repay the loan, and therefore that growth orientation is really important. It's more for businesses that are scaling than starting, but we don't define those terms deliberately. We deliberately want businesses to consider whether a loan is suitable for them and whether we consider that a loan is suitable for them. And that's probably going to be less around a pure startup that's brand new and perhaps more oriented towards businesses that are scaling. But the business has to be credit constrained. There has to be a real need for public sector intervention. If you're able to get funding for this project that you want to carry out for the growth of your business in the market anyway, please do so. That's what the market's there for. Taxpayer funding that we're using, and this is a form of state aid because the interest rate is below market, is designed to help people who need that stimulus, who need public sector support in order to do something that they wouldn't otherwise be able to do, or to do something more quickly than they would otherwise do. As I said, it's about later stage research and development. It's technically experimental development, and I have got a slide later on which is really long and lots of words, and I love it, but you'll probably find it rather boring, but it's important. So experimental development is the stage that we expect you to be at, and we want to see that clear route to commercial success. And as I've said, we want to take innovation risk. That's what we're there to do. We will take credit risk. We don't have appetite for taking operational risk. So the way the loan works is that, as I've said, we can fund between £100,000 and £1 million, and it can only fund the eligible project costs of that later stage research and development project. So it's not a working capital facility, it's not a revolving credit facility, it's not an equipment finance facility, it's not a bridge to a takeout of the next round. It's an innovation loan aimed at funding that R&D project. And it's structured in order to, we hope, to help you to do that. So there's an availability period when you're doing that R&D, and you would be borrowing over time. That period could be as long as 3 years, quarterly in advance, draw down the money, spend it on your R&D. The next quarter, draw down the next tranche of money, spend it on your R&D, and so on and so forth. And paying interest on the amount that you've borrowed and the amount that's outstanding at the time. And I'll talk about interest in a second. There's then an extension period, still part of your project, but the part of your project that is about testing the market, getting into the market, finding out what the value proposition, the business model should be, and perhaps generating some early pre-commercial revenues. Once you're generating commercial revenues and you're fully in the market, that's the end of the R&D phase, that's the end of the project period, and that would be then the start of the repayment period. That extension period could be as long as 2 years, but it will end either on the earlier of when we've agreed that it should end, or once you start making commercial sales, and we can have a discussion about what we mean by that at the time. And then there's a repayment period that could be as long as 5 years, and during that period you would be making repayments quarterly of principal and interest. The interest rate is, we believe, below market. When we ran the initial pilot, the first 5 competitions that we ran, we had a rate of 3.7%. That was set by our minister. In this extension, we've been asked by ministers in Bays and Treasury, and we think it's a good idea ourselves, to understand whether price really matters. In all the consultations that we've done before setting up innovation loans, in the first pilot program that we ran, we were told by borrowers, by applicants, by potential borrowers, that price wasn't the issue. The issue was the availability, the fact that this money was there. And we want to find out whether actually price does matter. So we will be charging 7.4% interest, but we're back-ending that. So in the availability, in the extension periods, you will be paying interest at the rate of 3.7%, cash payable at the end of each quarter on the amount that you have borrowed. And then separately, 3.7% will be deferred, accruing effectively in a separate interest-free loan account, so it's not compounding, and that will build up and then be added to the principal in the repayment period. And then in the repayment period, you will pay back the money that you've borrowed and that deferred interest and interest on the overall facility at a rate of 7.4%. And it's going to be interesting to see whether we suddenly have zero demand because actually that was the wrong thing to do, or whether actually people think, yes, that's below market rate, this funding is available, and therefore it's the right thing to apply for. It's a loan, and therefore it's a loan to your business. So if your project is successful, great, you will be able to repay this loan easily. If your project is not successful, it's still a loan to your business, so you will still be required to repay. And because it's a loan and because it's government funding and we're managing public money, it's not unsecured. We will take a mortgage debenture, so a fixed and floating charge over the overall assets of the business that we're lending to, because if everything goes wrong and there's an insolvency, there's an administrator, we want to rank ahead of the milkman or other unsecured creditors in order to hope that we might get some of our money back in the worst case scenario. If there is existing or future senior commercial debt that requires to have, that needs to have a senior secured first priority position, then we will be prepared to rank behind them in the event of everything going horribly wrong, what's called a senior subordinated position. The other thing that we want to do is to take a first charge, not subordinated, a specific charge over any assets that are purchased and any IP that is developed with the proceeds of the loan. And that's not because we necessarily believe that those assets will have a great deal of value, or that that IP will necessarily have a great deal of value. We're not going to be valuing that IP and lending against it as a form of collateralized loan. We're taking a specific charge, really again as a defensive mechanism. What we don't want to see is people who might, let's say they were a bit naughty, they would borrow the money, develop something really, really cool, allow that company to fail, keep hold of the IP and set up a new company and make a ton of money and not repay the taxpayer. That would be naughty. It's called phoenixing. We're trying to prevent that by having that specific charge over assets that are purchased. So we've got one borrower in our existing pilot that's purchased a helicopter. Their project is all about autonomous flight, so they're going to fly it without any people in, and yeah, it's probably going to crash. No, I'm sure it won't. But if it were to, it's probably not going to be worth a great deal. But if it doesn't crash and everything goes horribly wrong, yeah, we'd have a second-hand helicopter and we might get a little bit of money back on it. You never know. Probably not. So it's going to be a really cool project. Next time I do this and they're on stage, they're going to look at me and go, Nigel. Last thing I should say is that there will be what we consider to be appropriate covenants for the loan. So you will make promises to us. You will promise to have a certain degree of liquidity. So more current assets than current liabilities. You will promise to provide us with quarterly financial information. You will promise to have a monitoring officer turn up and make sure that your project is on track. You will promise that if you want to change control of your business through, I don't know, an exit to a whopping great company, you will ask our permission before doing so. And we will look at it at that point and think, either, being taken over by another SME is appropriate, carry on with our blessing, or if you've been taken over by a whopping great corporate, that's not what this loan is for, so go ahead and do that, but please repay the loan as part of that transaction. So covenants will be there in the loan agreement. A quick slide, really just saying a few basic things. We're trying to complement the grant funding that Innovate UK offers. We're not seeking to replace Innovate UK's grant funding. They're about finding and proving a new idea and collaborating. This is about scaling and growing a business. This has to be for a new, specific, discrete, later stage R&D project. It cannot be used to match fund, I hate that expression, but to provide the funding for the eligible project costs that are not funded through a grant, because that would be two forms of state aid for the same project, which is not permissible, in the same way that two forms of state aid through a grant or an innovation loan and R&D tax relief at the smaller company rate isn't permitted because they're forms of state aid. It's a pilot program. As I said, it is repayable. It's not free money. It's not contingent upon, if everything goes really nicely and you feel like it, then you repay. This is a loan to your business. As I said, it's a loan on beneficial terms. We think that the rate of 3.7% is below market for the sort of borrowers, for the sort of projects that we would be funding, and therefore this is a form of state aid, and the state aid is the equivalent of a grant inherent in the difference between the market rate of interest and fees and all the rest that might be inherent in a loan were you able to obtain one commercially, and my guess is that's 12-15% plus a whole load of fees plus kickers. We're charging 7.4%. That differential over the life of the loan is the equivalent of a grant. So it is a form of state aid. You need to be aware of that. And I think I've talked about all the rest of these things. The process. We're Innovate UK, we're really boring about process. So you need to register if you wish to apply in this competition. Registration costs you nothing. It does provide you with the information that you need, and we'd very much like you to do that. Once you register, you'll get an email, you'll get access to our wonderful FTP site. This is not yet on the Innovation Funding Service, I'm afraid. Next one should be. Touching some wood somewhere. And you'll get access to the FTP site. You'll get an email with the part A of the application, which is all about the project, and you'll get access to the project finance form, which is all about the financing for that specific project, and a business finance form, future cash flows, historic financial statements, and you will also then have to complete information about your business through a survey. We're working with Early Metrics to do that. The business financials need to be uploaded into that survey nicely as a PDF rather than a spreadsheet, but that's an easy thing to do. We'll do it and make it back into a spreadsheet to review. You have to do that by the deadlines, please, because if you don't do it by the deadline, you're not involved. We will look to make sure that you're in scope. That's pretty easy because it's an open competition, that you're eligible, i.e. you've actually filled in all the forms, that you are an SME. Part A goes off to our independent technical and commercial assessors. Is this a cool project? Part B and Part A get looked at by our credit team within Innovate UK Loans Limited, really at the triage phase to decide, are you plausible or wildly implausible? And those that are highly innovative and not implausible from a credit point of view go forward for detailed credit assessment, and then, if appropriate, if approved by the credit committee, then we will make a conditional loan offer and do the documentation, meet the conditions, and off you go. Some key dates, two really important ones are 11th of September is when the registration closes at noon. 18th of September is when your application needs to be completed at noon, or before noon, I should say. So Part A plus the project finance form uploaded to the FTP site, the survey answered, and the business financials uploaded as part of that. We'll let you know whether you're going forward into detailed credit assessment by the 1st of November, and we need projects to be started, that first drawdown to be happening in this particular competition before the 31st of March 2020, because we have spending commitments that we've made to government, to BEIS, so we're motivated to see money out of the door before the end of the financial year. So I'm going to go very quickly through this because I think it's important you should know how the pilot went. The first 5 competitions that we ran, we had a lot of interest. We went out and about. We had great fun talking to people all over the country. And please don't tweet these next few slides. They're shared with you for fun. They're sort of our management information that I think you will be of interest to, but it's not formally publicly information. We had nearly 400 applications looking for £200 million in loan funding. So in theory, we were about 4 times oversubscribed. 120 of those applications went through for detailed credit assessment, and we've made 73 loans. And how does it work? Well, we look at innovation and we look at credit, and if something is highly innovative and suitable from a credit point of view, it goes through. If something's not innovative and it's unsuitable from a credit point of view, or it's not innovative, whether or not it's suitable from a credit point of view, or just clearly not right from a credit point of view, no matter how innovative, it doesn't go through. If it's marginal, particularly from a credit point of view, then we're biased towards innovation. So those things that are a marginal decline, that sort of, they're not totally crazy, but sort of a bit scary, but really highly innovative in that top quartile, then we'll take them through for detailed assessment, and it might be a quick conversation of, actually, no, yeah, you are crazy, this doesn't work, or actually, now let's see if we can construct something, pull you through and get you there. And we have got some businesses where we've been able to do that. And this is sort of the waterfall of how it went. I said we had 393 applications. 68 of them hadn't filled in all the forms or done the stuff, so they got thrown out straight away. That's a real shame, a waste of their time. So there were 325 that were assessed and looked at from an initial credit point of view. 205 of those didn't make it, either not innovative or unsuitable from a credit point of view. We took through 120, 27 of those didn't make it through that detailed credit analysis, 5 chose not to go any further, so we made 88 loan offers, half a dozen of them didn't meet the conditions that we met or that we imposed on them in order to draw down on a loan, typically around raising additional capital to go alongside our loan, and another 7 of them at that stage chose actually to withdraw. So we've completed 61 loans. We've got 13 that are in documentation and ready to complete. And we've got 1 that's still pending a credit decision. Not quite sure that one's going to get there. And as I said, loans on average about £700,000. The loan amount on average was about £700,000, but the actual projects costs that people were looking to fund, partly with the innovation loan, were about £1.2 million. So we're putting money in alongside other funding, and I hope that shows that it's complementary to equity in particular. The average total asset value, in the first competition we took some quite scary credit risk, and by the time we got to the final 3 open competitions, it sort of evened out at around about £600,000 of net assets in the businesses that we were lending to. So pretty risky from a credit point of view. As I said, quite a few of the businesses that we made loan offers to, we said you need to raise some additional equity, and that meant that at least £21 million of additional equity was brought in to those businesses to go alongside our innovation loans. Other businesses where there wasn't a condition or who subsequently have raised equity, there's been another probably 5 or 10 million of equity raised by those businesses to help them grow. So we're very happy about that indeed. And I'm going to ignore that slide because it was just way too complicated. We are doing an interim evaluation. We've appointed SQW as the independent consultants to do that. They looked at reasons why people may be registered but didn't apply in the early competitions. They talked to some unsuccessful applicants, and generally speaking, the reason people didn't apply was either can't be faffed, too complicated, or the timing wasn't right. But those people did plan to raise additional capital, and they would think about an innovation loan in the future. And those that didn't receive funding from us, generally, their growth has been slower than they would have liked it to have been. So we hope that that shows that those that do receive funding do have that growth, and that therefore there's a good rationale for this to happen. There was some interviews with successful applicants, more are going on at the moment, and generally speaking, but we'll hear more from the panel in a second, the evidence suggests that we can run a process, and we've also had a lot of internal audit work and external audit work done to make sure that our processes are fit for purpose. And overall, there was positive feedback on the delivery aspects, but we'll hear what the three folks on the panel say, whether Scott was evil or Kat and Andy were indeed the evil twins, as I always call them, and whether I'm a pushover or just full of waffle. And generally speaking, there was this sense that there was additionality. Something additional happened because this loan was there. Something had happened more quickly, or something that happened that wouldn't otherwise have happened. That's the impact that we're looking for. And there's a report that hasn't yet been formally published, but we've agreed with them, and that shows that businesses already are spending money on recruiting additional staff. At the moment in the R&D stage, what I'm really interested in is seeing in a couple of years' time whether those businesses are recruiting people, employing more staff, growing for the delivery aspects of their projects, once they've scaled up their manufacturing or put in place their software as a service platform, and whether they're recruiting additional sales and marketing and other delivery aspects of the businesses. We think that this is showing business growth that wouldn't otherwise have happened. And these are some logos of some of the businesses that we're lending to. Callaley here, we've got Tang on the panel in a minute. And who else have we got on the panel? We've got Pace Groups, we've got Justine, and Shadow Robot, we've got Rich, who are going to be on the panel. But a wide range of businesses all around the country doing a wide range of activities, from scaling up manufacturing through to software development in healthcare, in advanced manufacturing, in a lot of businesses shifting from a consulting model to a platform model, and really growing as a result. Just some formal things. This is an open competition. Therefore, any technology, any market, anything goes from that point of view, but we do want it to be later stage innovation, highly innovative, preferably disruptive, really cool stuff that I won't understand, and with that clear route to commercial success. So we want to see game-changing, that's a great word, isn't it? Cool stuff. And this is a slide that I promised you that would be really boring. This is the definition of experimental development. This is what you need to be doing in your project. So later stage research and development. And the words that I would highlight here are things like prototyping, demonstrating, piloting, testing, validation of new or improved products, processes, services. That's sort of later stage, which might be, I don't know, technology readiness level 5 to 8 or something like that. Or maybe your TRL, your technology is quite ready, but your manufacturing readiness level is low, and you need to bring that up to the same level. Or maybe your commercialization level is low, and you need to bring that up and understand the business model and the value proposition, and really work out how you're going to generate revenues from this project. And this is what your project needs to do. Please, this is online, it's in the guidance for applicants. Please read this and make sure that when you're submitting your application and drafting your project and thinking about your business plan going forward, this is the part of the development cycle, the innovation cycle, that we believe is particularly scary for lenders, particularly long-term and probably not immediately generating cash. From an equity investor's perspective, this is the part that we think is really hard to achieve, and this is why we want to support through innovation loans at this stage of the process. Before we get on to the panel, Q&A, including from online, if there are any. Anyone got any questions? Rod? Sorry, we should be running around with a microphone. Will we be sharing the slides? I will be sharing the slides, but probably not the ones that I asked you not to tweet. This will come out to everybody as a PDF file, and not just the ones that you'll see. This is actually a 160 slide deck with the gory details. The instructions are in there. And I'll be very happy, they will be sent out through the KTN. The wonderful Poonam, who welcomed you with her team at registration, will be, provided that you have provided us with an email address and registered and turned up, including those who are registered and online for the webcast, you will receive these slides. But I would encourage you, everybody also to read the instructions, go to the guidance for applicants, look at the competition scope, etc. Other questions? Andy, the lady in the dark top dress top, I can't see from here, close enough.
Hi, I'm Hara from London Southern University. So we run an EU business support program at the university, and most of the things we do with the businesses fall within the state aid regulations. So I wanted to ask if this initiative is also falls also within this.
This is state aid, yes.
This is state aid
so
also.
Because the interest rate is lower than market, that represents a benefit to businesses. It's through Innovate UK's notified scheme for state aid under Article 25 of the General Block Exemption Regulation. So not de minimis, that's different. This is notified state aid, but it is state aid for this project because there is inherent benefit in that low rate of interest and the absence of fees. Yep.
During your evaluation.
Sorry, we need to get the microphone on because otherwise the people online won't hear. And if, Andy, you can duck to one side so that the, because you're standing in the...
Yes, that's working now. During the evaluation that you're making...
Andy, sorry, can you duck, please, Andy? Sorry, carry on.
During your evaluation period, looking at the projects, do you have the authority or the ability to decide that it's appropriate for a grant rather than a loan?
No.
No. So it has to be done as a separate application?
Absolutely, completely separate.
Okay.
Over here. Sorry, I'm making you run, Andy.
Good morning. My name is Clark Simmons. I'm with Newville Grid Data, and I have a question with 3 parts.
Okay.
So given the state aid issues and such, is this program compatible with EIS fundraising?
I believe so. But I would strongly encourage on anything to do with state aid or anything to do with taxation that you take independent expert legal and taxation advice, because I'm not authorised and nor am I suitable to offer such advice to you. But my understanding is that it's entirely suitable with EIS and SEIS, which are offered under de minimis to the business in respect of the investors.
Is this
God,
also then
smarty pants
compatible
online.
with the R&D tax credit offered by?
This is a form of state aid in relation to a project. R&D tax relief at the small company rate, typically known as R&D tax credits, is state aid in relation to a project, and therefore you can't claim state aid for both those forms of state aid for the same project. The R&D tax relief at the large company rate, typically known as RDEC, is not state aid and therefore may well be suitable for the project. Again, I would encourage everybody to take independent technical, legal, taxation, accounting expert advice. Talk to HMRC, they're familiar with this program. It's the same as getting a grant from Innovate UK because this is the grant. There is gross grant equivalent in this, so it's state aid in the same way. But basically, the short answer is you can't have an innovation loan and R&D tax credits for the same project.
Okay. And the third part is this program compatible with NIA funding from Ofgem?
I have no idea what that is, I'm afraid, so I don't know.
Okay, fair enough. Thank you.
It's a new one on me. We'll go here, then the gentleman with the glasses at the back.
By definition, so you say you can't have, so it's done on a per project basis.
Yes.
You're funding late stage R&D projects, so a
Yes.
substantial amount of the project, however you want to define it, has already happened and may.
No, that would be an earlier project.
So you define the project, as
You
the
define
big-
the project. In your application to us, you say, this is my project. It starts
Brilliant.
here and it finishes here. This is the project. These are the work packages, blah, blah, blah.
Brilliant. Okay, that's great. Thanks.
Cool. So the gentleman here with the T-shirt from South Beach, Florida. From the Keys even? Oh, how nice.
I have two questions. One of them is, if you have commercial sales, are you eligible for the project?
So I think there we need to distinguish between the project and the business. So in relation to the business, we're very, very happy to see businesses that are making money, that are selling products, and in fact, that makes it a lot easier for us to look at from a credit point of view, because you'll have some cash flows that enable you to pay interest and offer us some degree of certainty, both that you'll have cash flows in the future that will enable you to repay, and sort of demonstrates you've got a management team and some sales capability that will help you get there. In relation to the project, the point at which commercial sales on a purely commercial basis occur is by definition the end of the research and development activity, and therefore is the end of the project. If during the project period, and particularly during that extension period, you're generating pre-commercial revenues, so revenues that perhaps are not at full price because you're testing an early version of something, where maybe you're testing out, should this be a sale or a lease opportunity? Should it be by subscription? Do you want to, I don't know, do value-added
So
pricing?
trials, I guess.
Trials, user-facing trials that are not fully commercial, then we would consider that to be pre-commercial revenues, and would be very happy to have a conversation with you during the period to make sure that it fits within that definition of pre-commercial.
Thank you. And the second one would be, are there any personal guarantees for
No.
the loan? Okay. Thank
No
you.
personal guarantees are required in respect of this. Sorry, I should have said that earlier on, because that's one of the key selling points. Stupid me. The gentleman with the glasses and the stripy shirt.
Oh yeah, I was actually going to ask about the guarantees, but I was also just relating to that. I think in order to be able to apply, you need to prove that you can't get the loan elsewhere. So
We
if
would
another,
ask you to demonstrate that you're suitable and that there is a strong need for public sector funding, which probably means that you are unable to get money from elsewhere. I don't expect, or we don't expect, or require you to send us a rejection letter or a tape recording of the bank manager laughing, because that typically, sorry, that's Scott's joke. I have stolen Scott's joke on that one. I need to admit that. And Scott's joke got far more of a laugh than mine did. But we would ask you to effectively to tell us that story of why public sector money? Why not just go and do it normally?
okay, thank you.
Thanks. Right. Any questions from online?
Yes. Let me just read them out. Are you able to use the loan to buy an asset to carry out your innovation on a large scale?
You are able to use the loan to purchase an asset where that asset is part of the project. So capital equipment can be an eligible project cost to the extent that it's used in the project. So it's not a straightforward equipment financing facility. So if you want to borrow money, buy a machine and not do any R&D, the answer to that would be that's not a project, that's not research and development, that's just buying an asset. But if you're, I mean, I gave the example of the helicopter. There is a company that's buying an asset, it's quite significant. It is being used in the project, and to the extent that it's used in the project, it's an eligible project cost. If that company uses that helicopter partly to test out their autonomous vehicle, flying vehicle software, and partly for jollies down to Nice, because they want to go gambling in Monaco, the elements that are about it, that using it going to Nice for gambling trips are not an eligible project cost, because that's not in the project. If that helicopter has a useful life of 50 years and their project lasts for 5 years, then 5/50ths of the life of the, and therefore of the cost of the asset, is an eligible project cost.
If you've applied for an Innovate Smart grant and failed, can you still apply for an innovation loan?
Yes. You may wish to consider whether the project is appropriate, whether the stage of development's right, whether you're the right sort of business, but there's in the competition brief there is a specific statement, I can't remember exactly what it says about previous applications, yeah, we don't rule people out from applying at least once more after an unsuccessful previous application.
Does it matter if pre-commercial sales are overseas if the business is UK based?
That's fine. Very happy to flog it wherever you want. The more the merrier.
Will there be other competitions of this sort later in the year or in 2020?
It's our intention to, it's our expectation, it's our hope. I think I'm not allowed to say it's our intention. Yeah, in September.
Great, thanks.
Okay. One last question from the gentleman over there with glasses, and then we'll get into the interesting people. Not that you're not interesting, it's that the panel's going to be more interesting than I am. Give me a bigger hole to dig, please.
From the non-interesting delegate. Are loans appropriate to startups if they're if R&D is what they're about?
It depends on the financial condition of the business. If you're a brand new company with £100 of equity and you want to borrow £1 million and you're going to be doing some early stage R&D and maybe you'll get there to market in about 10 years time, then I don't think that's going to wash. If you're well capitalized, you're not yet generating revenues, you're doing later stage R&D, there's a clear route to commercial success, you've got the right sort of team to get into the market, and you can demonstrate that, then certainly we would take a look. Okay, thank you very much indeed for the interesting and relevant questions. Okay, over to the panel. So Justine, Tang, Rich, if you could join us on stage, and Rod, to moderate. The purpose of this is, you know, I've given you my sales pitch. I've given you a little bit about what the interim evaluation said, but let's hear from some real borrowers and see what they say about whether this is crazy, appalling, or super duper. Wherever you want to, if you want to come here, that's fine. You need to be by a mic though.
Okay. Yeah. So, good morning, everyone. I'm Roderick Beer, and I'm the Managing Director of the UK Business Angel Association. I'm just going to quickly introduce me, then I'd like to introduce the panel separately as well. In a nutshell, we're the trade association for angel and early stage investing. So, our role really is to help support those that deploy capital at early stages. We look after 200 organisations across the UK that deploy over £1 billion per annum into early stage startup, scale-up companies, ranging from across the whole of the UK in different sectors and different technology focuses. We have a big focus around obviously supporting and growing innovative businesses, and that's why we're very pleased to be supporting working with Innovate UK and some of the work that they do in providing that crucial early stage funding to help support the growth and hopefully scale of companies, because from our perspective as an equity kind of investor hat on, it's all about growing, scaling, exiting, creating returns and creating success for UK businesses. So I'd like to now ask each panelist in turn to introduce themselves, if you could. We'll start with Justine, you're close to me.
Sure. Justine Prain, I am one of the founders and operations lead for the Paste Group. We're a coffee company. We have cafes in London and Bath. We have a coffee roastery business and a distribution business that works in the UK and Ireland. The project that we have applied for the innovation funding for is a water project. So one of my business partners, hugely passionate about innovation, done a bunch of studies on what makes the perfect water for coffee, and discovered through that there was no real solution for homes. So what we've created is the first adjustable water filter jug for home, and applied for the innovation loan in the final round of last year for that.
Justine, Tang.
Hi, my name is Tang Vota. I am the co-founder of a company called Calily. So Callie has, together with our chief medical officer, invented a revolutionary new feminine hygiene product, or we prefer to call a feminine care product. Women haven't seen a new product in 80 years. We spent many years patenting that product, selling a lot of prototypes and getting to manual production, but we are very, very fortunate to have been backed by a £1 million innovation loan to help us scale and build manufacturing facilities. So I was just sitting where you were a little bit over a year ago, but very happy to be on the other side.
Rich.
So hi, I'm Rich Walker, Managing Director of the Shadow Robot Company. So we've been making and selling robot technology for about 20 years, exploring markets and testing product ideas. In that time, we've had a constant stream of business selling very, very niche products at the high end of one sector. And we wanted to move either that way or that way in the Ansoff matrix. So we tried various things, various funding, European, Innovate UK funding. We never quite got our process right. The exploitation work package never really exploited. Dissemination was fine, but exploitation never really took off. We eventually realized that this was because we weren't treating exploiting our technology as a service that we had to deliver internally to ourselves or a product that we had to generate. So we got the innovation loan in order to set up that process internally, to be systematic about taking our technology, finding potential customers, analyzing them, and working out how we could deliver that technology to them, and then building prototypes to do that. And part of the reason for taking the loan was that we're an employee-owned company. We are exactly off Rod's books because we have absolutely no plans ever to exit and no interest in taking equity finance because that would require us to generate exits. So the innovation loan is pretty much the only finance mechanism available to us as debt or equity investment.
Thanks, Rich. So I think we've got a lot of company founders, people who work with a lot of company founders as well in the room. I think it would help perhaps to try and help the people in the room to understand the kind of stage and the situation you were in as a business that made you think, hey, we need to innovate, we need to grow, we need a loan to help unlock this certain aspect of our business to take things forward. So perhaps, Justine, maybe you can give a bit of a picture as to where you were in a growth development from your business, you know, employees, what were you turning over, kind of where about, just give them a feel for where you were in that growth trajectory.
Okay. Well, as a group, we have a number of parts to our group, obviously, across the retail and wholesale, which for our project is great. But for us as a business, it meant that we were around 7 years old, and we had funded entirely through private investment, mostly friends and family, so equity investment. And we were just at the point of, our turnover's around £4 million, and we were just at the point of becoming cash flow positive, so in this financial year that's just closed. And we had this fantastic idea for this project, which we thought was really innovative. We saw a real need for it in the market, but our current equity investors were wanting to see us be able to kind of consolidate and grow and get some momentum on our core business. So it wasn't that we really had the appetite from them to be able to fund something that was much riskier and more innovative, like the project that we had. We'd done some Kickstarter funding, we'd demonstrated that people were interested in the project, we had, you know, both households and kind of wholesale customers interested. But again, we just weren't at the stage where we could unlock anything like banks, equity finance, anything like that. Grant funding for a consumer product like a water filter jug, we couldn't find a grant fund that fit. So for us, this was absolutely perfect in terms of the fact we were at the point where we'd proved concept, but needed the funding to really scale up and take it from super early stage prototypes to much more sophisticated prototypes, finalizing all the kind of design elements. And now where we are is we're actually moving into tooling. So we're partway through our tooling and moving into manufacturing.
And given, I guess, that you had, you know, your equity investors saying, stick to the core, grow the core. Did you feel that by did you manage that relationship quite well with them as well in terms of saying, well, look, we still think we need to innovate in this area too, and innovation loans can unlock that? Were they very supportive of that, or was it just like, we're just going to crack on and do what we think's right?
Oh no, I think our investors are hugely supportive of that, and watching, you know, what is a great idea. We're really fortunate to have as one of our founders The guy who's done a lot of the research behind this project, who's got an international reputation in kind of water for coffee in that world. So being able to demonstrate to these people that we, with the right finance, could take an idea and speed it up and start to get it to market has been something that they're hugely supportive of. And I would imagine from here, we're going to start fundraising again, probably in the next 3 months or so, and innovation and research and how we can take that to market will be a big part of that story, and this project will give them that confidence.
Tang, tell me a bit about where you guys were in terms of your development as a business and how you think this can help accelerate what you're up to.
Sure. So as I mentioned earlier, one of the most senior gynecologists in the UK invented our product. This is based on being a gynecologist here in the UK for 35 years, and he invented a new product which we call a tamp liner. So we tested this on thousands of women, and it was undeniable that there was interest in this product. And so it's one thing in business to invent a product, get a couple patents, but it's a whole nother challenge to develop a business, but also to commercialize that product. How do you make this make it commercially viable? How do you automate the process of something you've invented? So the background of the industry is that as I said, there's been no innovation in 80 years, but even for the existing products that exist, one of the largest femcare manufacturers in the US, they recalled just before Christmas, 2 years worth of tampons that were manufactured. So not only because girls were going to hospitals, literally, so it didn't make the news, but it should have. It only did on CNN. So you've got an industry that's not innovating, but not only are they not innovating, the products that they have, they keep on cutting corners and not caring enough about quality. So the entire ethos of our company is not only innovating in new products, but also believing in a higher standard of quality. And part of that quality means that we want to keep everything where we can keep a careful eye on that quality here in manufacturing in the UK and not overseas or in the Far East or et cetera. So as tempting as it would be to try and find partners to help commercialize this, build automation machines and look elsewhere, we really wanted to do it here in the UK. And in the UK, luckily, it's one of the world's best automation experts exists in the UK. So if you got a great product, you know that there's massive, there hasn't been any new innovation for 80 years. It's a $40 billion market. You would think it'd be easier to raise money. But if you raise money by equity, you're giving your company away. And a lot of people are motivated, especially VC firms, just to make as much money as possible. That's not what we're about. We want to make a difference in this world, believe it or not. We're very proudly a B Corp. So how do we find the partners that are the right type of capital to help us manufacture and solve the innovative challenges we have to build full-scale manufacturing? And very fortuitously, innovation loans came about. And we told them that, you know what, we've spent 10 years fighting for patents. We know how to manually make our product, which has been backed by smart grants. But we need to build full-scale automation. We want to build a factory, and we need partners who believe in what we're doing. And Nigel and his team very kindly gave us this £1 million loan. And it has been completely transformational for us because it has just opened the floodgates of great commercialization for us. So that's how it helped.
Amazing. And moving on to a probable expert in automation, Rich. I mean, you guys, you've been in a position where you haven't needed to take equity, which is great. How is it that, what were you doing? Were you trading? I mean, what was the loan kind of, do you see is its the best use for it?
Sure. So we've had a model over the last decade where we've basically been selling premium products to a niche market, and that's been pretty stable, turns over $1 million a year in a good, reasonable year, a bit more some years, a bit less other years. We've also been heavily engaged with the research community, so we do a lot of European projects, a fair few Innovate UK projects, and that tends to bring in, it can bring in $500,000 a year of business as well, and that's all R&D. So that's generating technology, and the challenge was getting over the bridge to turning that into actual deliverable product rather than just another, we've shown we can do that, but we haven't quite got the business case right, and the customers aren't, so another interesting outcome. So we had a significant development contract come in the door. We knew we were going to make some money doing that contract, and we knew we'd hit that classic point where if we weren't careful, we were going to have one really big customer and all of our attention would be on that customer, and if they changed their mind, we'd be screwed. So part of the reason for looking at the loan was actually to offset that risk. We could, instead of saying, well, we got this money coming in from this customer, let's spend all the profit on that doing our R&D and hope to get somewhere with that. We could say, well, actually, let's borrow this money, spend that doing focused R&D that's actually going to deliver a product, and the profit we can actually build up a reserve in the company. Because that was something we'd never actually had. The classic thing where you're running a startup and you're bumping across the bottom all the way along. If you have a bad week, that's okay. If you have a bad month, if you have a bad 3 months, then things get very, very squeaky. So building up the capacity to not have that problem was part of the reason for actually looking at this loan.
And it gave you the ability to focus on your core, the core technology to commercialise and build and grow, and give you that breathing space that you needed to be able to do that, and not beholden to one customer, which is, I guess, a fairly common problem when you're developing new IP as well. That's really interesting. So I guess coming back down to Justine, it'd be good to understand when you're looking at kind of thinking we want to solve and grow and innovate in this area, what other sources of funding did you take a look at, and did you try and see if you could apply to this area what you were doing?
We looked at all the traditional stuff. So we looked at grants, and there wasn't at that point anything that would be open to us. We looked to our banks. They weren't terribly helpful. We looked at the criteria around the British Business Bank. And obviously we did go and talk to some of our select kind of founding investors as well. But at that point in time, it was just all sort of too early stage. We'd either been around too long, so we weren't strictly speaking a startup, or the idea in and of itself just wasn't fully developed enough, and it was still too high risk.
Tang, how about you? I mean, given that you're not taking in equity, you haven't been taking in equity, is that right? Similar to Rich, you've been looking at other sources of funding. What was out there for you guys? I mean,
no, we definitely have taken. We've definitely taken equity, for sure, and we continue to take equity. But it's always a challenge to find the right type of angel investors who are aligned with your values. I can't look any of my existing investors or new potential investors and tell them we're just doing this to make as much money as possible. No, we think that profitability and making money is a reward for doing what's right. That's always a challenge, trying to find the right type of investors. And as everyone knows, venture capital firms, as an example, want a liquidation preferences or reverse vesting or preference shares, all this stuff, which is just, it takes over your company, because when you're a startup and you want to, your set of values are based on quality and innovation and keeping things here in the UK, that it can work against you and doesn't gel with trying to make as much money as possible. So in terms of your question about financing, so we have gotten grants before from Innovate UK. We obviously got this loan, and we have taken equity investment in terms of EIS and SEIS as well. To answer the gentleman's question, we've been able to do both without any problem. So we're always looking at all types of financing.
And when looking to kind of solve this particular this kind of innovation issue that you're looking to, what other forms did you look for to potentially give you the finance required to do that?
Well, nothing beats not having to give away the company, right? So if you can get your hands on non-dilutive equity, of course that's the best thing. But no bank would touch us, right? Because no one's ever built this machine, and no one's ever built this product, let alone the machine itself. Who would? The interest rates would have been astronomical, and you could continue to raise a lot of equity, but you have to give away your company, as I said, which is what every founder wants to avoid. So it was really innovation loans or nothing. But when I say nothing, it's not that we wouldn't have built a machine, we just would have had to compromise. What the loan allowed us to do is we went for the best people possible, so we could build the best machine possible, world-class experts. If not, we would probably have to go to Asia and find a cheap way to build a machine, but that's not what we wanted to do.
It gave you the breathing space to make the right decisions, basically, as a business, and to do the right thing, which sounds good.
Yeah, no, absolutely. And there's one thing that Nigel didn't mention in his presentation that I wanted to say, but this loan has been fantastic in terms of speed of execution. So I have a finance background. I'm admittedly a former venture capitalist, so that's why I want to avoid the people like me from where I used to be. But it's an incredible 3 months from when we submitted our application until drawdown. That speed, time is money. Everyone knows here we'll never get time back. But to have, and this was during the summer last year as well, we probably could have gone it faster if not for August in the middle of it. But that was unprecedented. To have 3 months from when you submit an application and you draw down, that was fantastic.
Great. And tell me, Rich, about from your perspective, what do you think this has kind of done for your business growth? I mean, I'm not sure how long you've had the loan for, if you might have managed to draw much of it down, but what is it really doing for you in your business?
So we're 2 quarters into an 8-quarter process. And actually, it's been interesting because what it's given us is a very clear focus on the fact that this isn't an R&D project we're doing. This is us borrowing money to do something that we will have to pay back later. And the entire management team goes, why are we doing that bit? Do we need to do that bit? Is that really the right thing to spend that money on? Because we're spending our own money for once, instead of getting Innovate or European Commission to finance a development project that might or might not succeed. This is, we're spending our money, we're just borrowing it from future sales. So that's actually made it really key to the management of the project, to get the focus, the attention on it. I'd say the other thing it's done is it gives us the confidence to say, well, actually, we can just hire somebody with a remit to do that piece, because we have 2 years of guaranteed finance in place to cover that. There's definitely the resource there. And we know that provided our projections were sensible, we will be able to pay that. We are borrowing from our future selves, but in a way that we're comfortable with doing. So that was actually really important to us as well.
Oh, excellent. So it kind of gave you a bit of a buffer zone to kind of come out from, using Nigel's term of grant junkies, into kind of building and pushing in to grow a business, because you've got to pay this stuff back, right? And
yeah.
It's not an easy loan. It's not a loan. So back to you, Justine. So tell me a bit, what is it doing for your business? What is it doing to help grow? What have you seen already as a difference from the loan that you've received?
Well, I mean, I can pretty categorically say that we would not be anywhere near where we are today. We just would not have had the money. We also were at a point where we were doing it part-time alongside our day jobs, whereas we've been able to put the focus and resource into it. So we're now pretty much, production samples should arrive in the next 2 weeks. Always delays, of course, with these things, but fingers crossed. And so we're able to really now go out with confidence and start talking to a market who's actually already super interested in this. Like I say, Maxwell had built up a brand and reputation internationally around water for coffee. So being able to go back out to, coffee companies all around the world and say this product that people have been hearing about for, I mean, we've been at this for kind of 2.5 odd years. And before that, he'd written a book which sold 15,000 odd copies. So there's already the interest and demand, and we're able to go and say, actually, this product, this is coming out this year, 100%, definitely. So we're getting interest from people who want to distribute in different parts of the world, as well as, everyday people who just want to buy it online.
And how did you find, I mean, we've heard from Tang about the application process. How did you find that process yourself as well? Given that you've done equity before, so you know what equity can be like, trying to raise that round can be a pretty long-winded process, and not always successful either. How did you find it with Innovate UK?
So in terms of the speed of, application through to drawdown, I 100% support what Tang's saying there. It was really incredible in terms of putting an application. For us, I think it was 4 months rather than 3, but that's really phenomenal. And it was really clear in terms of the timelines as well. So you knew exactly when you'd hear back, and exactly what the different parts of the process entail. And, unlike a grant, being able to then get all that approved and then draw down your first, amount of money quarterly in advance. So you just crack on. I mean, that is pretty incredible. The application process is not to be underestimated. You've effectively got, a grant application and a loan application that sits alongside it. So, I would definitely make sure you left enough time for that. But we've honestly found it a fantastic kind of transformational process.
I guess one of the plus sides as against equity is that there is actually an application process, where in equity you're just canvassing and trying to raise that money from people and kind of hitting the pavement a little bit. So it makes it a bit more guaranteed, a bit more structured if you're fitting in the right within the right area.
I also support what Rich says actually about focusing your management team. For us, we're a group company, so we've got a number of companies that sit within our umbrella company Pace Group. So we've had to, sign up to covenants and agreements across our whole group for the most risky and innovative project that we have on our books. So you're right, it does focus your attention on, how you're running that project and making it a success.
Great. if I can just jump to you, Rich, about the application process and how you found it as well. We've got 3 months, we've got 4 months. What was how was yours?
I think ours was a little longer, but we had some entertainment getting the finances sorted out in the discussion process. We've been around for a long time, which means that our accounts are, I wouldn't say complicated. They've been audited in the past, but you know, when you start looking back over a long period, you can find all kinds of interesting things that you've done previously. And that wasn't necessarily a barrier, but making sure that we could hit the financial metrics and we could put those processes in place, which we hadn't needed to do before, that was challenging. But that was after we got essentially what you might call the proof of concept acceptance. Okay, we're happy that we could invest in you. We are going to talk to you about closing the process. And I echo the idea that it's really nice to have a structured thing where you say, okay, we've written this, there's our Innovate project. We've written this is our financial application, and we're now having a conversation with Nigel and his team basically about whether that will work for them, how it will work for them, and what guidelines or rules need to be in place for it to work really well. So not quite as fast, but I think the only other project I've ever done where I effectively borrowed 650,000 was a European one, and they pay up front, which is nice. But for those of you who've ever had FP7 or Horizon 2020 funding, 1.5 to 2 years, 16% success rate if you're really, really lucky. Not as good a mechanism.
Thanks, Rich. I think I am keen to kind of move on and give plenty of time for some Q&A, because I think we had lots of Q&A of Nigel, but Nigel's very biased about innovation loans. So we've got three people who've been through that process and are using it. And I think actually just be good to get an overview. And we'll start with you, Tang, as to any of those out there who are thinking about or looking at innovation loans. What would you like to have known before the process, or to get ready before you got involved in it, prior to engaging with innovation loans? Any kind of advice or guidance that you could give that perhaps you wish you'd known before you started the process, or straight through, very easy?
I think that's a difficult question for me, because I will say for us, we deal with feminine hygiene products. We deal with menstrual blood. No one wants to read or talk about this, right? So we know what we face on a daily basis. So as an example, we are big fans of SMART grants, but we have had 4 very painful rejections in the past. And as you guys know, who have applied, that can take up to 100 hours per application. So we have been rejected again and again and again. So when this innovation loan thing came about, and reading it on the paper, and this sounded perfect for us, we went for it all the way. So one recommendation I have for anyone who's doing the innovation loans, there are a lot of optional appendices. We did every single one, and we went to every single maximum page, because any opportunity for us to show visually or sell our company or what we're doing was an opportunity that we took. So I guess if we got rejected and I didn't use the appendices, I might have said I wish I knew that. But I will say on the flip side too, considering the painful rejections we've had with the grants, the loan process was in some ways a breath of fresh air, because it's not completely opaque. If you pass the initial questions and a couple initial credit stuff, they actually come into your office and want to meet with you, right? So my issue with the grant process, but I understand where it is. The last SMART bucket had 1,200 companies apply. I mean, the resources to try and meet everyone would be phenomenal, but because the loan thing is a pilot, and the government wants their money back, I really appreciated that, with interest, of course. But I really appreciated that we had a chance to sell ourselves to the innovation loans team, and that made the difference for us, because we didn't have to on paper try to sell our company. We could sell our business, and again, when I say business, it's not just a business, but it's also our team. So that's one suggestion I have too. If you are just 1 or 2 founders and it's just you running this business, I don't really think you'd get this. I think the reason we got our loan was because they saw that we were a business, a team that they really liked. So it was other things that I wish I had known. No, I mean, we tried one first time and we got it, so we're pretty happy. But it took a lot of work. It's never easy, but if you don't quit, you keep at it. But again, like I said, I'd really embrace every opportunity that you have to sell your company on paper, and then be prepared for when they come in and chat.
Same question to you, Justine. Have you got any thoughts or pearls of wisdom you can share with the audience here if they're thinking about innovation zones as well?
I mean, I had experience of Innovate UK grants in a different kind of world that I'd been working in. I'd worked in an environmental world on energy efficiency and renewables, so I kind of understood that process. And you can't reiterate enough just to go through it in a really methodical and structured way, and really think about what the application questions are asking, and make sure that you are hitting all the points that they need to know, because you don't actually have that much space in some of those boxes on the application form to get your idea across succinctly, and just leaving enough time, really, because it is a significant process. There are a significant number of appendices, so making sure that you get that right. But yeah, again, we got it first time as well, and the differences for us in terms of being able to have that interaction with the Innovations Loan team as well, and go through that assessment process. I just really couldn't recommend it more highly.
Richard, anything you want to add to that? I mean, given it's done a bit of shaking up for you guys as well already.
I guess two things. One is that we did something with this application that we hadn't done with Innovate UK applications in the past, which was to get a consultant in to review it. We normally don't do that. We know what we're doing with grant proposals. We've done quite large scale ones. So we normally think, actually, we know our business, we know what we're trying to do. But because this had the whole part B that we hadn't used before, and because we were quite determined to get it, we brought in a firm who just provided us with an expert to read the application and then tear it apart brutally. And it came back absolutely dripping with red ink, which was great, because then we were able to fix all the bits that were dripping with red ink and turn it into something that actually made sense to a reader on the first time going through it, and wasn't, because we build our applications from several different parts of the company, you don't necessarily get a coherent read through, because project management wrote that, finance wrote that, innovation wrote that, business development wrote that, and so you need to get a coherent message across that. The second thing, rookie error, the interest payments start being due in the first quarter of the loan, not after the deferral period, which changed our financial modelling a bit, but we didn't notice that until we were reminded that we were due an interest payment. And I sat down with my finance manager and we said, what? Huh? And we looked and went, oh yeah, we didn't spot that. But then we have just shown all our financial modelling to everybody, including Nigel's committee, and no one else spotted that we hadn't put the interest payments in the right quarter either. So we got away with that. And we are making those. But yeah, that was it was a slight surprise, because it meant that the total amount that we are going to pay over the time changed, and the time we started to pay it back changed. It didn't have a significant impact. It was just a kind of annoying, like we thought we'd read everything twice and we just missed that clause there.
Great stuff. So I think maybe perhaps a little bit of summary from me, then we're going to open the floor to Q&A as well, so you can ask them about how else you can get around Nigel and his financial checking as well. I think it seems to me that this kind of innovation zones is all about that kind of, you can see the light at the end of the kind of commercialisation tunnel as well, and you are going for a loan, and you are going for something that does carry interest and wants to be paid back, and so you do need to potentially sell yourself in, is that right? To kind of get the loan committee, to get Nigel and the team as well, to really get behind you and your business as well, hence they want to come and see you and get to know you as well. You need to be showing that you can kind of, that your IP is not to kind of develop and continue to grow that IP, but to get it over that final hurdle to get to start building sales and to growing out the business, which is really interesting. I'd like to now open it up to the audience for Q&A. So anyone got any questions for our panel here? Gentleman down the front, if you get a microphone running down here for the online.
This is Florencio Cuervo of Libby Limited. My question is, I was very interested in how to build the finance on the company, starting company. And I see two ways. One, because I have been exploring equity, but also loans and built on escalation. So what would be the recommendation for an industrial bound startup, which has some digital part of it, but basically there are two streams of building on the technologies and going up to the market. One is going to get equity, and the other is with funds for grants and loans and hold the equity within the company and potential partners. Can you differentiate with these two streams on building the company?
I'll take a first stab at that, if that's all right. And hopefully this will somewhat answer your question. But in terms of your situation, I wouldn't assume that things are mutually exclusive. I wouldn't think it's either equity, it's either loans, it's either grants, or it's either venture debt. The way we did it is first, again, by way of my background, you never want to raise too much equity, right? You want to find the right partners, not compromise. But you don't have to raise all that money right away, right? And what we did is, and again, what I like to add to what Nigel says, he says innovation loans are affordable, flexible, and patient, right? I add the word prestigious, right? Because we were able to leverage our innovation loan to about $3 million more of equity since we got the loan. So with that in mind, what I would suggest is you continue trying to raise some equity because you need some to get started. You apply for the loan, and then you leverage that loan and the prestige from that to show to other equity investors that if you're putting more money, look, it helps us with the loan, or then it's a mixture of all the different types of financing. So I wouldn't just choose one or the other. That is the strategy we used. So we used a bit of everything. In fact, happy to say we got another SMART grant as well last in the most recent bucket. So there's a momentum that can be created when you get something significant like this loan, and then use that to leverage equity and other means of finance.
Thank you. Any other questions from the floor, from online as well? Do you have any questions? I think we've got a question at the front here from the gentleman down here. We've got some online as well.
Hi, question I think probably for Justine. I think there may be a good parallel with us. We've got an existing business which has been trading for a long time in international express transport. Now we've created a new entity into which we're going to put the IP for this project, which sounds similar to perhaps what your group has done.
Yep.
Because we want the IP to go in there. And in fact, what we're going to do is going to disrupt the market so much that it's going to make our existing 20-year business completely redundant. Can I just talk through how you manage that process with your new entity to manage the water?
Okay.
project?
So everything to date has been done through our group company. So the patent applications, the trademarks, any of the IP, any of the agreements have all been done through the Paste Group. And we will open up, well, we've just incorporated Peak Water Limited, and then we're going to license the IP to Peak Water Limited. And we've had to take various bits of advice around how we can get all the right, kind of patent box and, different advantages. So I wouldn't underestimate getting some good advice on R&D tax credits, EIS, all that stuff, how it all fits together. But yeah, for us, IP in the top company that's borrowed the funding, then licensed down into Peak Water Limited.
Brilliant, thank you.
We've got a question up there, then we'll jump to online as well.
Hi, thank you. Ryan from IntelliSense. My question was potentially to all three of you. What milestones did you set in the initial proposal which you think were instrumental in being accepted for the loan? And have they been met, or would you go back and change anything about them?
So for me, there was basically one milestone, which is, have I now got a commercial product in a real market sector? That's it. If I don't do that, then I've spent the money, but I haven't got a success. If I do that, I've got a success. Nice, simple, clear.
In our case, we had several milestones and several deliverables. So we're innovators, but we build things. So we have lots of engineers. So we very methodically put out a Gantt chart, listed some major milestones and deliverables for each one. And I think that's what probably helped in our case, because you can't just say you can't just say the machine turns on. We needed to like go, various steps and milestones that were very tangible, definable, and had a date on them.
Likewise, we did a detailed project plan because we had to go from what was a fairly rudimentary prototype to more sophisticated prototypes that were verified, then through to final design, tooling design, where we are now in terms of getting the tooling manufactured, all the way through to actually having a finished product in a box, and the associated, launching websites, communications, etc. that go with it. So, very detailed plan. We are behind a little, but all very explainable and making our way through our milestones and confident that we're going to hit them, just perhaps not within quite the timescale originally planned.
Thank you.
Great, thanks. Let's see some questions from online as well. From
Yeah. Hi guys. Please could you speak to how you demonstrated sufficient creditworthiness to meet Innovate UK requirements, and how was that process?
So I have a first go. We showed all of our historic financials. We also had to obviously demonstrate share capital, so showing the funding we'd taken to date in terms of all of our equity investment. We hadn't at that point taken much more than a very small amount of debt finance into one of the businesses that sits as part of the group. So largely it was about mapping out the historics and then a full forecast showing how we were becoming cash flow positive, and indeed how we would grow revenues both from our core business and the new business that would be sufficient to repay the loan.
I'll add to that too, and use it to sort of share something I wanted to share as well. Is for us, obviously it was challenging because we've been spending years R&Ding and not too revenue generative. We've done some tests to prove that people would buy our product. So in some ways it was very hard for us to be able to borrow this much money. But I guess we had a robust plan and forecast, and I don't know, Nigel and his team ask anyways, if someone's close, one of the conditions can be that you have to raise more equity. So that's one of the things the team will do. If they like you and they think there's a chance, they'll work with you to solve those issues. But I did want to mention one thing, seeing again Nigel's presentation. It's just tragedy when you see people who've actually been accepted, but then they don't draw down or they weren't eligible. So do yourself a big favor and make sure you read the black and white. And I would suggest there's one thing you look in particular, which is the EU state aid rule on state aid and companies in distress. Sorry, undertakings in difficulty, UID. And for any of you fellow companies that might spend a few years, like, because we're older than 3 years old, right? So if you're older than 3 years old, all your accumulated losses you obviously have in your balance sheet, but that cannot exceed a 50% threshold of the total shareholder funds you've ever raised, right? So I'm not going to go into too much details, but that just means that you need to meet this financial ratio to be eligible for this loan. And for some people who've been spending a lot of years, that's difficult to hit that ratio. That means if I've spent, for example, if I were to spend £5 million over the last 5 years doing R&D, it's into my P&Ls as losses, I need to have raised £10 million of capital. So just be careful of that, because there is no getting around that. So save yourself some time and make sure you're eligible for this.
Scott will have a slide for that after the break. It's a really exciting slide.
Right.
Conscious of time. Any more questions online as well? We're eating the coffee break. So I think it would be great if you can give a very warm round of applause to our fantastic panelists.
Thank you very much indeed, Justine, Tang, Rich, and Rod. We have a 15-minute break for coffee, tea, banana milkshakes, ice creams, whatever's outside. If you're online, don't go away. Go make yourself a cup of tea or whatever, and come back in 15 minutes from now, and we'll talk about part A of the application, and then Scott, who's really the person that all these guys have been lauding. Okay, come on in, take your seats. Welcome back to everybody who's online. Right, so you've heard sort of effectively the sales pitch from me. You've heard testimonials from very happy businesses who are really growing and using innovation loans. Hopefully that will give you a sense as to what we think good looks like and what you hopefully will think good looks like. Now we're going to talk about, we're not going to go into the gory details of the application process, but basically there's two parts to it. Part A is this a cool project? And part B is, are you a sensible business? Sensible as in grown up, ready to take on a loan. To talk about part A and that project application, we've got Ian Tracy from the Knowledge Transfer Network, who's going to talk about how to answer the assessor's prayer. Over to Ian.
Thank you, everybody. Do you ever remember the end of term when your school teachers used to go home with that stack of books for them to mark? Were any of you children of school teachers? And do you remember the process where how they would methodically churn through them? And depending on the teacher, they might be distracted by something else, possibly a drink, possibly a radio. That's essentially what happens, unfortunately, when people are paid to go through your grant application that we're going to talk through. You're going to be assessed by 10 questions of 400 words. You have to make every word count and every word easy to understand. And so if you think that people are churning through these, you know where to place it. And so one of the first things we're going to say is answer the question asked. The number of times we see repeated 10 times, this is an amazing product that's going to make a lot of money, or variations of a theme, doesn't help. Also be completely prepared to get other people to read your work and check it out. Scott from the Shadow Robot Hand gave the feedback that said, even though that they have used grants considerably in their company, they did ask somebody to review their work and it came back dripping with red ink. And you sometimes forget what it's like when other people have to read your work from code. So make sure you get time to have somebody to go through it with that editing, with that clean set of eyes, and give you that refresh towards the end. So the project summary is not scored, but it is used to select your grant assessor. So your grant assessor gets a bunch of project summaries and they get asked to pick a certain number based on their workload, and then the others go in for a second or third reallocation. So I would suggest if you get your project summary compelling, easy to read, it helps the experts to self-identify, because they'll be thinking, that's one I understand, that's the one I can get through, that's one for me. So put a lot of effort into your project summary, and it's one of the ones that I say go back and rewrite at the end and make sure it's got that wow feature, and don't be distracted by the we will not score this. It carries a lot of weight. And as it says, think of the economist. Assume they're educated, but not tech geek experts in your field. The active tense is important because it keeps people reading and keeps them engaged as you go along. Public description, that's just so that people can read what your project's about. But actually, it's a little bit of sales and marketing, because that's going to go on an Innovate UK website describing where the money's gone. You've no idea who's going to read it. Might be used by suppliers or collaborators or customers. So don't treat it too trivially, and make sure you put a good effort in. Scope. If you get this wrong, you're rejected. They don't read any further. They don't score your application. So the best way of doing this is read the scope question, copy and paste the relevant piece down, and move it into the answer. Let me give you an old example from about 6 years ago. We had a grant that was based for the Harwell Space Cluster. Now, I happen to work there, and I know that the ESA Business Incubator is based at the Harwell Cluster. And some people had written for scope, we are based in the European Space Agency Business Incubator. And then they were rejected because the person assessing them didn't know that that was based at the Harwell campus. So all they had to do was at the end go, comma, Harwell, and the assessor would have seen the magic word Harwell, and they would have passed the scope question. So a little bit of copy and pasting. You also have to take in mind the assessor's going to trust what you say unless they have reasons to doubt you, and they're not going to use Google or follow web links on your behalf. They're going to read what they see. So why do you need the money? Why does the market need this thing that you're talking about? So explain to us what is the thing the reason why it's going to exist and how you're going to fix it. But put it in the wider context that shows that you understand the true market. And you might find the Horizons tool at the Innovate UK website particularly useful. This is the crib sheet that the examiners will get to score you. And if you quickly read through it, you can see it builds up upon it. Now, I was asked at the break, what score do you need to pass, to succeed? Well, it depends on the grant, or the competition to be precise, the competition that you're in. But to put it in perspective, I would tell you to consider it to be the equivalent of a first-class degree. If you're not right at the top, you're unlikely to get funded. The competition for these sort of projects across the Innovate UK funding landscape can be quite difficult, and a lot of people.
In innovation loans, we'll consider 70% and above typically.
Thank you. You're one of the few people, so I'm going to repeat that. Thank you, Nigel. You're one of the few people who give such a precise number. Nigel just said for innovation loans, they will consider 70% upwards, which about a little bit more refinement. I'm going to stop there before it gets more complicated. So what's your approach? How are you going to solve it is going to be the next question. Tell us how it's based on earlier work. And the beauty of talking about patents shows that you've got a freedom to operate. Don't be afraid to tell us what the output's going to be at the end of this project. And often I would urge you to put a nice pretty picture in Appendix 2 so we can get a little bit excited about it. For the team, I'm going to urge you not to be so modest. Please try and lose that English mantle of, well, we could be quite decent if we tried, but get a lot more bold and brave and tell us that you are the best people to do this, and the only thing that's stopping you is this grant or loan that you've applied for, and what you're going to use those resources to get you to that destination. We also want you to know that you're aware of the market, but really give us good demographics so we can really understand who you're talking about. Always remember that if you do say, we only need 1% of this market, me personally, I interpret it that as shorthand for, because I don't really know what I want. Because if you are not talking to 99% of the market, you're wasting 99% of your marketing effort. So work a lot harder on your segmentation and get it down to a sensible group. When we're talking to investors, I would normally suggest 15 to 25 or maybe even 40% of a segmentation, and then you know you've got your segmentation suitably refined. Always helps if you can refer to third-party data sources, and bear in mind that they won't be followed up unless they've got reason to disbelieve you. What's going to happen with this project? Tell us what the value proposition is to the customer and why they are going to see a benefit in what you're doing and why it's worth it to them. How are you going to connect and find them to it, and where you currently sit in the marketplace, and describe the journey that it's going to take you along. These are the softer, wider benefits, which could include the environment or the social elements. It's also helpful if you can attach some financial numbers to these benefits, and of course the key word on that slide is guesstimate. But don't be afraid, especially of the local benefits. We want to see that the money is going to change the world around us. How are you going to make sure that the project is going to be delivered on time and to budget? It's got to be appropriate project management for the size of the project to hand. If you were going for one of the smart calls and you're just asking for £25,000 and you tell me you're going to hire a Prince 2 project manager to oversee it, it's probably unbalanced. If you're spending £1 million in the automotive sector or aerospace sector and there's a Prince 2 project manager connecting with your suppliers and the wider supply chain, that's probably more appropriate. Gantt charts are easy to understand. Throw one of them in appendix for question 7, and that'd be really helpful. Risks. It's the funny one, isn't it? We want to know safe enough that it's going to succeed, risky enough that nobody else will touch it. And that's your challenge. You're looking for that little Goldilocks moment where we're the people who are happy and nobody else is. When it comes to the risk register, think about doing it pictorially with the different axes. Make sure you label them so we don't need to guess what they are. And tell us how you're going to manage those risks. I think the big challenge here is describing those risks in a credible way, because you tend to be a lot blah, 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 blah. And I think the more you understand a project, the more specific and unique to you and your project those risks are, the more believable it is. What's the added value of the public funding? This is where you're telling us that without this public money now, we're not going to go ahead, or we're going to go ahead slower, or we're going to go ahead at a smaller scale. That's all quite negative. If you want to describe it positively, you could talk about unlocking private investment at the end of this stage, because you're providing the evidence for private investors to feel comfortable with the opportunity that you're going to present to them. And funnily enough, we want to know how much it costs. And given that it's government money, we want to know that it's great value for money. If you're going to use subcontractors rather than project partners, justify them. Is it their skills that you need, but it's only a small part, so you're not bringing them into the project? Their skills you're only going to use once, so you don't want to build that skill in-house. And then tell us the return that we're going to see in the wider economic activity, both directly in the form of taxation and indirectly with things like productivity, efficiency, and contribution to the wider softer issues like diversity and inclusion. Small print. It exists, and I would really urge you to use the competition helpline, because as Nigel said, they reach out and speak to us anyway, but their answers are a lot more legally binding than me telling you something via email. And you do see spikes in the questions surprisingly close to the deadline. So if you can pull those questions in a bit earlier, you're more likely to see that happen. I was asked during the break about grant writers, and the point I would make is, if you're inexperienced, consider the grant writer, because they're going to have the scars that you're missing. Rick used one on this project, on this loan system first time round, and that is a company that has grown through the grant system. I think that's quite telling. The hardest part on the assessment for me is the variety. The assessors do meet a quality metric. They are assessed from our point of view to ensure that they maintain quality. We look for outliers when we see the scores coming back and it's managed. But still, you always seem to find one of them that seems to loathe or not understand you, and you always seem to find one of them that wants to marry you almost. It's just the nature of the beast. To me, that indicates that your messaging and your communication is more complicated than it needs to be, and see how you simplify it and make it more engaging, so as they're churning through the papers, they engage with yours. They're the top tips for you to come to and read later. The deadlines, we keep on talking about noon. If you see the graph on the computer server at noon, it shoots up in load. And normally, if it falls over, that's your problem, not our problem. So I think you used to be able to submit a draft the day before and then replace it with a later version on the morning if you had to. So there was something in the system. But the best way of doing it is submit it the day before when nothing's happening on the computer, and just tell yourself it's the date a day earlier, because we all work to deadlines, don't we? don't underestimate how much time it takes for your consortium to agree with it. And when you get your different consortium members writing different pieces, that pushes for a bigger importance on the editing to make it come across with one voice. And I think the rest of them you would understand. We do have an electronic copy of the Good Grant Application Guide, which you can download. I believe these slides are being shared after this presentation, so you'll get a copy of it then. I'll wait for the photograph. Thank you, Nigel. It's rather sad he's taking a picture of the slide rather than me, but never mind. Excellent. You will hear us talk about the Innovate UK family. The Innovate UK family is made of three main groups. You have ourselves as the knowledge transfer network, which are UK-wide technology-centric expertise. If you look at the European Enterprise Network, they are UK-wide and they have geographic knowledge. So if you want the best local view of an area, I would say go to the EEN. If you want a national view within a technical sector, come to ourselves at the KTN. And we do have, from memory, 12 catapult centres, which are centres of excellence around the country in specific themes like digital, satellite applications, advanced manufacturing. The advice that you get through all of them is essentially the same because it comes from the same source. So don't feel compelled to sort of work your way around speaking to all of them. Once you personally connect with one of them and it's working, because at the end of the day, this is a human being talking to a human being, that should work. Leave it there. For those of you questioning the existence of the EEN in the current political climate, I will just leave with you the thought the EEN is about 54 countries and it has more people in it than the Commonwealth. It just started off in Europe many, many years ago and it's grown since the, so speaking personally, and I'm sure somebody's going to be sending me a text message later telling me to repeat the word personally, I can't imagine anything changing to the EEN in the short term. And I think finally, you can sign up to our newsletters and get information relevant to your sector in your inbox. My last thought before I finish and hand it back to Nigel, I imagine, for Q&A. When you're going through the grant process, work hard in explaining why you're that unique one that is worthy of the support and how you're going to transform the world. And please don't be another set of blah, blah, blah. Thank you. Questions, please.
Cool.
Evidently clear. Thank you again.
Thank you very much indeed, Ian. Really, no questions. That's surprising. A couple of things I would add. On question 9, that's the part when talking about added value. That's where we're looking to see that, well, why an innovation loan and not just, talk to your local high street bank manager. That's where the added value of public sector funding comes in, and that's where you should be describing that. And in relation to question 10 around costs and value for money, in this competition, we will make available to the assessors the project finance form, the full project finance information that you provide in order that they can see what you're proposing to spend on labour, on overheads, on materials, on capital equipment, etc., overall, because that enables them to see whether what you're proposing does represent good value for money and an appropriate cost for the sort of project that you're describing. So you should be aware that the assessors will see your project finance form. They won't see your business financials. That goes to Scott and the credit team. So that was the part A of the project. Part A of the application, which is all about the project, the R&D project. And bear in mind, please, that we define project in innovation loans covering both the availability period and the extension period. So that whole period of when you're doing that later stage R&D and when you're getting into the market. So please make sure that in the work packages that you describe, that you take that into account, that you recognise that definition of project that we're inviting you to propose to us. Part B, in the pilot, in the first 5 competitions, we had a Word document and a really, really super helpful spreadsheet that everybody utterly detested. So teach me to try and be helpful. So this time round, with this competition and probably the next one, we're looking at a slightly different way of capturing that information about your business. So instead of there being a Word document with 7 questions asking you to put stuff in and appendices and this god-awful spreadsheet, we're working on a different approach, which is that in order to capture information about your business, your management team, your experience, etc., there's a survey questionnaire that we're going to invite you to, require you even, to complete. And that's on SurveyMonkey, and it's run, it's working with a company called Early Metrics, and I'm very pleased that Will and Jean from Early Metrics are here, and they're going to give you a very quick introduction to who Early Metrics are, what their high growth or their startup high growth index survey is all about. They've got some real academic rigor behind that, and it's not just capturing a few nice bits of information and then throwing it to us. It's also looking into your businesses a bit, comparing them with other early stage businesses, scaling businesses. So a quick introduction to Early Metrics from Will and Jean, and then it'll be Scott who's going to talk about our approach to credit, so therefore sort of rounding out the Part B side of things. So over to you guys.
Couldn't have said it better myself.
Thank you, Nigel. Or you need to be at the lectern.
That's all right. It's gonna be no problem. So thank you very much for this opportunity to present Early Metrics today, and also presenting our use case with Innovate UK today. First of all, who am I actually? So I'm Ginger Ian of the two of those. I'm the country manager of the UK and international office, and I've been at Early Metrics for 2 years now. 2 things you really need to know about me. I love pink socks, which you can't see right now, but standing a bit to the side, and I'm more than happy to come back to the front. And also dreading to hop on the Northern Line later today. So the key facts about today. So who's Early Metrics? Have you heard of Early Metrics before, actually, before today? So, no, so it's good that we hired a marketing person, and basically, Early Metrics...
Then you're visible online.
That's right, thank you. Early Metrics is the leading rating agency of tomorrow's economy, and we help our clients such as Barclays, Innovate UK, HSBC, and many more to make more efficient decisions when it comes to startups, thanks to our ratings. So I'm sure you've basically heard of, or you've seen the movie Big Short, where there's this scene where the 2 guys walk up to the agencies, the rating agencies, sort of challenging their rating approach, their business model. We're completely different. Our clients are not the startups we rate. Our clients are corporates and investors and institutions. And what do we actually assess? The growth potential of startups over the next couple of years, which is based on 3 key pillars: the management, the project, and on the market. And on top of that, and that's the use case of today, we have developed a high growth index, which will present you a bit more. Handing over to you.
Okay. Thank you very much, Gene. Hello, everyone. So I'm Will. I'm an account manager and product owner at Early Metrics, and yeah, I'm delighted to be working with Innovate UK loans on this particular project. Essentially, there are 2 main objectives of what we're doing. So first and foremost, it's to improve how we go about identifying and selecting, as Nigel calls it, sensible businesses, but it's also for us high growth businesses as well. The second part is also to improve user experience for you guys, because I wasn't involved in the previous years, but apparently it was clunky. They wanted to streamline it a bit more, so we've tried to bring in some fresh air to that as essentially a startup ourselves in many respects. So the first step to that has been to design, build, launch a brand spanking new survey on SurveyMonkey, but we're calling it an application form as well. I won't go into that in too much detail because I believe that's going to be Scott's part. But as Nigel kind of roughly said, it's broken down into 7 parts. Just quickly, that's basic information, HR and company structure, commercial activity, product development, finance and funding, key growth challenges, and then finally it's the financial information which you'll be submitting via a template. The step after that, and that's where essentially we come in with what's called the high growth index, which is a tool or an automated tool that allows us to collect this information, interpret it, and actually translate that into a score out of 100, which is then broken down into the 4 key pillars that we assess, which is, as you guessed it from the survey, team, commercial activity, product development, and funding. That information will then be fed back to Innovate UK. You can then use that information, or not use it, however much you'd like to use it, to actually supplement their decision making for the process. So really excited about this particular pilot, really excited to see how your businesses actually come through on the actual index itself. And yeah, if you have any actual questions on the model itself, how it was built, feel free to go to our website, earlymetrics.com, or email me directly as well, william@earlymetrics.com. I'm sure you'd have loads of questions about how we built that, but it would take me quite a long time to go through it as well. But no, thank you ever so much.
So, Will and Jean, thank you very much indeed. Actually, the one thing I was going to say about the that survey was the categories, and I was going to have to flick all the way through to a whole load of slides about it. So thank you, Will, for saying what those question categories are. The business financials template is and perhaps at the end I'll skip through because I've got a picture on a slide. It's basically a very simple template asking for information about turnover, and by turnover I don't mean grant income. I mean turnover, EBITDA, and some core balance sheet categories, current assets, cash, inventories, current liabilities, etc., historically and for the next period of time over which your project or your loan will last. So those forecast financials, there's a template that you can download from the FTP site in Excel, put the numbers in, export it to PDF, and then upload it at the end of the survey. So you'll provide information on the survey, upload the financials, and then, as Will says, we will receive that information and the scoring around that index. We will use both of those information, both the detailed information and the index score and the financials, put that together with part A, and that's the basis on which we will look at the suitability from a lending point of view. And our approach to that, I'm going to hand over to Scott, who's our head of lending operations and risk at Innovate UK, and like me, a director of Innovate UK Loans Limited, and like me, we're 2/3 of the credit committee. Tim Sawyer, our chief investment officer, is the other third of the credit committee. We're the folks that make the credit decisions. So having Scott explain our approach to credit, I hope will be helpful to you, so you get a sense of what to us good looks like and why we might form those judgments. Scott.
So I guess the key thing is what I'm really going to speak about is very similar to what Ian said, which is how do you make Part B compelling and interesting, and how do you convince us that, in the words of Nigel at the very beginning, you are not completely unlikely to pass any form of financial assessment, so you're not utterly implausible.
I didn't say batshit crazy.
You didn't say batshit crazy today. You said it yesterday. So, I mean, a very similar process. And the great thing about credit is it hasn't really changed. So I'm able to go through my career involving RBS, corporate commercial, banking, finance, credit, some time in government, come back 10 years later to business finance and find that it's exactly the same as it was when I left. Because essentially the fundamentals of credit don't change. And the way that we approach it is no different to the way a commercial lender would approach it. It's just that when we see the answer to the question as being maybe, possibly in the future, that doesn't put us off. We are asking the same questions. We want to understand the character of the business, their likelihood to repay, so we will look at track record. And unlike assessors where you don't expect them to follow links, we will follow links that you don't even give us. So we're working with Eligibility on this. We have a bit of a desire generally to work with exciting UK-based fintech companies. So we also work with Judil, who are based about 100 yards down the road from where Eligibility are based, to provide data scraped from news websites, from Companies House, from ratings agencies, because we are fundamentally curious and cynical. So we will go digging and having a look because that's actually how we get a sense of it. But at the same time, there are 2 credit specialists in my team. And Nigel put up a slide earlier where it said effectively we looked at nearly 400 applications last year. And 2 people looking at 400 applications while also executing existing transactions and managing a portfolio. They need to be convinced relatively quickly. So I mean, Andy's sitting at the back. I remember Andy sitting at his desk once and shouting out, "This balance sheet doesn't balance." And at that point, you've probably fundamentally lost his trust in your numbers. And he's either going to spend 6 hours digging into it, or he's going to say, "For God's sake, this isn't ready." And actually, as you know, in the early days when we only had a small number of applications and we were launching this and we were really keen to get things up and going, we probably made the effort to drag them up. As the volumes increase and as this becomes hopefully more and more popular, that will be more difficult. So we look at the character of the businesses. So things like CCJs, things like failed companies in the background. None of these are barriers or absolute barriers to progress. But if you know these things are there, tell us about them, explain what it was. We've had companies where we said, well, there's a CCJ here, and they go, yeah, that was a mistake, and here's the letter. Very easy conversation at that point. The management team and people. So typically a debt provider isn't looking at that, they're looking at historic performance. What we're looking at really is we're taking a bet on those future cash flows. It's like forward cash flow lending, which even pre-2008 wasn't an easy thing to get over the line. And fundamental to that is, can we trust the management team of not just the project, which Innovate has always been interested in, but the business too, to deliver what they say they're going to deliver through the project, to deliver the business plan. So we want to know about the CEO and the CFO, as well as the technology officer and the project manager. And that's a big part of what we look at. It's almost like what you try and convince an equity player to look at. And we're in that sort of strange hybrid space where we're doing debt analysis, but with some equity aspects to that. So it's a compelling and convincing story around that. Obviously we crunch numbers. In fact, we get Andy to crunch numbers because he can do maths. We need at least one member of the credit committee who can do maths. So that's Andy. And we're interested in liquidity over and above anything. So you're always taught in credit, cash is king. And that's what we're looking at. So I know there were some questions earlier about pre-revenue businesses, certainly pre-profit businesses. In fact, I don't think I've seen a profit in the last 12 months in most of the application forms I've looked at. When we started, we originally thought, and Nigel and Rich helpfully pointed out, you need to cover interest from the end of the first quarter, which has occasionally come as a surprise, which is a bit of a worry. But you need cash to do that. Now, we recognise that pre-revenue companies, pre-profit companies aren't going to meet interest cover ratio covenants based on EBITDA. When we started, we hoped they might, but that's just not the case. So Nigel was talking earlier about reasonable covenants. One of the early covenants we look at is a liquidity covenant. So it's having enough cash in the business to meet your ongoing obligations each quarter. And if you were taking a traditional bank finance, you might look for 2.5 times cover on the liquidity ratio. We look for 1.1 times. Yeah, so we're being generous and flexible in that. And sometimes the answer is go out and get some more cash alongside. That's why sometimes we say this deal, this loan offer is subject to some equity coming in as well, because that provides you with a package of funding to take it forward. As you get towards the repayment period, we hope that you will have grown your business sufficiently that you'll be able to have a traditional debt service cover ratio, so the ability to meet the repayments, capital and interest. Again, we're talking about 1.2 times cover, not 2.5 times cover. It's right at the far end of even what I was doing at RBS in 2006-07. No, I wasn't being quite as risky as we're being here, which is quite something because I was drunk a lot at that time. Leverage. There are leverage cover ratios within our lending manual. It's not the biggest concern, but sometimes it's about that balance sheet strength. And we'll come back in a moment to talk about the undertakings and difficulty test, which Tang mentioned. Sometimes it's not about passing that test. Sometimes it's about being fundamentally capitalised sufficiently to take on debt of up to £1 million. So that's something we will look at. But again, there's no hard and fast rule where we will say it doesn't meet that ratio and therefore we're not doing it. That's not how we work. Market understanding. So you've done some of this with the technical assessor around the projects and the opportunity. If your business is wider than that, we will also want to understand your resilience to economic shocks, what mitigation strategies you have in place. Do you actually understand the market you're selling into? Do you have a sensible funding plan and delivery plan and sales plan? So what's your business model? Now, some of that might be evolving through the project. Part of this project could well be business model development. So it might be you're looking at SaaS models, or you're looking at licensing models, or something else that's into a market. So understanding what your planned direction of travel in that respect is really helpful. As Nigel said, innovation risk is something we are willing to take. Credit risk is something we're willing to take. What we can't do is take operational risks, because that is poor management of public money, and that's something with which we are tasked both as directors of the company and as public servants as well. So understanding the political and regulatory risks associated to what you're doing, we want to see that you've considered those and understood them, and we want to understand your control culture. You know, if we're giving you this money up front, quarterly in advance, it's cash out the door for government, we want to know that's going to be well managed, well controlled, the project is well maintained, and so on, and so is the business. Now, I guess the one thing I'd reflect on there is we see quite a few businesses don't currently have their own full-time FD. No, £2, £3, £4 million businesses quite often don't have a full-time FD. But where we see companies that have identified that and outsourced that, that's a positive. And when that outsourcing isn't just about bookkeeping, but it's about some strategic finance advice and sort of forward thinking around how you're structuring your balance sheet, what are you doing with your intangibles, how are you looking at your future funding plans and options, how are you designing that process and the build out of your company so that you will attract funding in the future. That's where you get real certainty around this stuff. So it's not necessarily about having done it, but having identified it and the need to do it is really good. So left-hand side of that is the, left-hand side of that is how we run through our process, our considerations as we go. Essentially, the thing on the right is our Chief Investment Officer's version of that, because he learnt it 20 years before I did, so that's an even earlier version. But essentially, it's the same thing. The one thing I'd note on there is that collateral is a bit bigger. So we talk about being reasonably secured, and Nigel's already talked about that a little, but we can talk about that a little bit more in a second. Undertakings in difficulty. Who has come across this concept? Ian, 2, 3, a few. Who's had Innovate grants before? Did you come across it in the context of Innovate UK grants? Okay, you will. So, the undertaking difficulty test is something set by the European Union, and it's around ensuring that what the state is doing is it's not providing aid which will artificially prop up a company and keep it going in a way that distorts the market. So if a business can't subsist on its own without the intervention of the state, then it probably shouldn't be running, is the argument that they're taking. And they've designed out a test in the current version of the General Block Exemption Regulation, which, as Tang said far more eloquently, is if your retained losses are more than 50% of your subscribed share capital, you qualify as an undertaking in difficulty, and you are therefore ineligible for aid under the General Block Exemption Regulation. And that includes grants under Article 25, the same way as SMART, many of our programs, Article 26 around research infrastructure, Article 47 around recycling technology infrastructure. Anything that's within that basket, you cannot receive if you are an undertaking in difficulty. Now, there are some mitigations around this. So if you're under 3 years old, the Commission accepts that you would probably fail this test. So it doesn't apply to businesses less than 3 years from establishment. Unfortunately, that means that if you established a company, did nothing with it for 3 years, and then you're coming back to it after that event, sorry, it's from establishment. It's just the way the system works. We typically look at the last set of financial accounts. If what has happened in the meantime is that you've raised some equity, or that you've you've achieved a particular milestone and the shape of your business has changed, or you've changed your accounting policy, for example, in the way that you recognise intangibles or the way that you account for R&D activity, please send us some management accounts with your application, because we can look at the up-to-date position. We have to apply this test at the point of commitment. And sometimes it's about us understanding, and what's the gap? So if the gap says, you know, you need to raise 500,000 in order to mitigate this test, and then you recognise it within your funding plan, that's a really good tick. It doesn't stop you progressing if we think there's a reasonable strategy for you to mitigate that and to move beyond it. So it's worth flagging that there. And the other option is around deferral and conversion of liability. So the real answer on that, speak to your accountant. If your accountant doesn't understand it, get a new accountant. Yeah, but come with a credible story around how you're going to address that point. And that will be true for anything you do with Innovate UK and any other form of subsidised funding you're looking for from government. So, all this stuff comes into us through early metrics. We get a nicely formatted report as soon as we worked out what that looks like. The information goes in, we get the benefit of their high growth index analysis. We overlay our own analysis from the information provided in Part B and Part A, because the credit team are nosy and want to know everything. We look at the undertaking difficulty test. We give an initial feel as to whether it's affordable or not. And we try and make a decision as to whether it's appropriate for debt finance. We don't want to be substituting for equity. We're happy to work alongside equity. Our risk appetite is getting towards equity, but our return is still down sort of by the equity provider's boot basis. So we don't want to be substituting for equity risk, but we're happy to work alongside them. And that initial view of the management team, does it look credible? Does it look sensible? And they're the sort of initial things that we look at for that plausibility test that Nigel was speaking about. At the same time, our independent technical and commercial assessors, 5 of them for each application, will look at your Part A. Those things come together in an innovation quality line draw. I'm going to say 70%, Nigel, and not say ish. Who knows? In some programs it has to be higher just because of the volume of fantastic applications we get through. But typically we fish above the line. So anything which is more than 70, which is reasonably credible in the way that Nigel's described, we will look in that pool to try and take forward the most innovative but still reasonably credit-worthy businesses for detailed analysis, where we really come out and kick the tyres and come and meet you, speak to you, maybe reshape the proposition. We are happy to come back and say, you've asked for 500,000, we think 3 looks more realistic. Or actually, in a couple of cases, you've asked for 500, why aren't you asking us for 800? And spend 300,000 of your own money, you're going to dedicate this to building your marketing resource and doing that earlier to hit the market. We're an unusual lender, we come out sometimes and offer more money than people are asking for. And sometimes that's essential. But that is a conversation and it's a discussion. Once we know that you are both credible from a credit point of view and sufficiently innovative, you will get your initial feedback, which is either no, and we'll try and make that as quick a no as helpful as possible, so that allows you to get a sensible answer and you're not left dragging along for 6-9 months as you might be within the commercial process. And you'll get feedback as well on the innovation. So you'll get all the assessors' scores and comments. You'll also get commentary from the credit team. And we try and make that as helpful as possible without being offensive, to give you a steer. And we've had applications that have come in where we've declined it on credit, and actually they've come back next competition or competition after, having addressed those points, and they've succeeded in getting to funding. So it is worth looking at that. I say we try and be polite. Occasionally we haven't been. That was me. I apologise to the company in Northern Ireland, but they were technically insolvent and I was right and they were wrong. But we try and make that a helpful process. So Nigel's already shown you a version of this, but with some numbers on that you weren't meant to see. But essentially there is that slight bias towards innovation quality. And you know, if it's shaky from a credit perspective, but it's really, really innovative, we will try and drag it up and drag it across the line and get to the point where we actually make an offer. There are obviously some of the ones that we're still wrestling with now, post-drawdown, and trying to keep them on track and keep them going, and they're quite intensive to support, but it's worth it for that innovation benefit that comes out that back end. So, you get through the line draw, you get through that initial analysis, you get to detailed analysis, you go through all of that, you get to meet Kat, Andy, normally Nigel and myself as well. And we make an offer. It comes back to credit committee, we make an offer. That offer is always contingent on a management presentation to the credit committee. What Nigel calls the say it out loud test. Some of us have different words for describing that, but the say it out loud test is essentially what it is. We want to come and see you in your premises. We want to see the machinery, the processes, meet the people who are actually going to be delivering this stuff, and have the story told to us in a way that is credible and meaningful. We've had 2 companies fail management presentations post-offer. One lovely day out in Teesside, which led to the, my God, we're not lending to that conversation in the car on the way back to Newcastle Airport. So it is a sensible, I think, incredible way of going about making a good decision around public money. And it's the same sort of pitch event, the same sort of narrative you might have to give when you're raising your next round of funding from equity investors or from the commercial world. Actually, we find it quite useful, and sometimes it turns into a free sort of corporate finance seminar where Nigel holds forth for an hour and a half and the rest of us do our emails. But some businesses have found that incredibly useful, and I wouldn't want to discount that. And then once you get to,
raise more equity.
yeah, the conversation is usually, why are you raising $1 million now and then $1 million in 3 years' time when you need 10 in 6 months? That happens a lot. You get people drip feeding a lot, and actually scale, getting to scale is really important. So, normal thing, gets a final offer, loan agreement comes out, it's a relatively standard form. We've negotiated it 73 times now, so I'm hoping we don't have to keep negotiating it. So it's getting close to being sensible, and we're having some conversations with new lawyers around making it more plain English and more easy to go through. Obviously, working with your lawyers on that. We go through your normal checks, your normal banking finance checks around know your customer, anti-money laundering, PEPs, and so on, which is carried out by our lending admin partner, who are currently known as Growth Company Business Finance up in Manchester. They have been Business Finance, they've been the Enterprise Fund, they've been various other things. They're part of the Growth Company in Manchester, and they effectively do our banking services for us. And then corporate authorisations. In grant world, it's great. The project manager comes along, signs it, free money arrives. Wonderful. This is a debt. We want to see board approvals, director's signature, and various other things. We want to make sure that you guys know what you're getting into. And we want to take that bit of the process seriously as well. But we can move relatively quickly. Once you get your loan, we actually get to operate it for you. So, first drawdown, sign the loan agreement, satisfy the conditions, the money comes out. So those of you who've had an Innovate grant before, that normally has to be on the first of the month, and normally before that happens you have your baseline meeting with your monitoring officer. We start the project period actually from when we draw the money, and that can be any date within a month. So if you want it on the 12th, if you want it on the 17th, that's fine, and that's day one. The monitoring officer will then come out within the first 60 days to do your baseline, because we've already paid you your first quarter's money. That baseline will establish what the second quarter's drawdown is, and then after that they will come and check what you spent in the first quarter. So we're always looking retrospectively rather than looking at what have you done this month and then put a claim in. So we're always sort of ahead of that cycle. So it's a slightly different process. Whereas Innovate Grants use a system called _Connect. Any fans? No, we don't use _Connect because we weren't fans either. It's managed by our credit team and by the monitoring officers, and that includes things like project change requests. So if you want to move money from here to here, I don't really care because you've got to pay it back anyway. So that's signed off at the monitoring officer level and signed off with the relationship manager if it needs to, unless it's substantially weird and it's changing the project or changing the credit risk, at which time the credit committee will have a look. But we tried to make that a simpler process for this, recognising the fact that you do have to pay us back. Quarterly drawdowns, so you will submit a plan for that. That plan will change, and it will probably change every quarter, and you just agree that drawdown schedule, and you agree that between the monitoring officer and your relationship manager. Your relationship manager is the same person who took your application through the credit process, so they will know you, they will know your business as well, so you get to keep that relationship officer the whole way through. You pay your interest quarterly, quite important. You pay 3.7% running in this competition, 3.7% is deferred. And the way that we're deferring that is effectively debiting it to an interest-free loan account so you don't get a compounding of interest. So we're trying to reduce the burden of that. When you get to the repayment period, it's added into the principal and off you go and repay at 7.4. So we're trying to make that sensible. We're trying to keep the cash drag on the business as low as we can during the project period when you're actually doing the work and trying to get your innovation to market. Extension period, no more drawdowns, still deferring the interest. You're doing that activity of actually trying to get into the marketplace, testing your model, beginning to make those pre-commercial revenues, even if they happen to be at full price. So those things that Nigel's talked about, and we can discuss further, I'm sure, in the FAQ around that. You still keep your monitoring officer because you're still doing your project at that time. So we invite you to define a project as the availability plus the extension period. So that's up to 5 years. Very helpful for capital, equipment purchasing and things like that. It's a 5-year project, up to 5-year project. At the end of that, the MO says thank you very much, probably gets a job in your team or goes off to manage another project. And we move into that repayment period where there are no further drawdowns and you just start paying down. But you keep your credit specialist, your relationship specialist through that period as well. They'll come out and see you maybe once a year, do an annual review, or they'll come out and see you once a week if things are beginning to go south and there's some intervention that's needed. So the idea in that period is see as little of us as possible because you're making a massive success of it and just meeting your commitments going forwards. That's it from the credit side. I guess questions in the wrap up or questions now, Nigel? Questions now? Yeah, questions now?
Thanks so much for that. So, just looking at the grade.
Thanks.
Oh,
okay, wow, sorry. So just a question on the commercial revenues bit. So as far as I understand it from Nigel's talk this morning, whatever is defined as commercial revenue, when that starts, R&D is deemed to have finished, right? And you then mentioned something very interesting, which was, well, there might be somewhat commercial revenue, but not quite commercial, and it's still counted as pre-commercial.
Yeah.
Is that basically discussed with you as sort of, we're making a bit of money, but it's not really the amount that and then you sort of say, yes, that's fine, it counts, and there's no hard and fast rules, is that right?
Well,
or not?
It's the definition of commercial revenue, isn't it? So there is nothing to stop you selling a product at full price within that period. It might be that you haven't quite got your manufacturing costs down to where you want it to get to in order to make it a firm product going forward. You might be offering a small discount in order to get, in exchange for data feedback from the clients, to therefore continue that iterative improvement. So if there's still a sense of finding the model, proving the product, getting it to fit within your sales model, even if you're making revenues which are pretty much what you'd expect to make in that commercial period, it might be that the costs aren't quite right yet, and therefore you're not quite at the full commercial sales point.
Okay.
And yeah, absolutely, that's a discussion with the relationship manager and so on.
And if you've got, say, for example, a commitment to buy at some point in future for the full price, but not actually bought it, then that still counts as pre-commercial, presumably.
No. Yeah, it feels like it, yeah.
Completed sale, then
yeah.
What's going to happen in the future? See what happens in the future.
Yeah.
Okay, right, thanks.
I'd be quite cynical about that. That's jam tomorrow, isn't it? So
that sounds what, sorry?
That's jam tomorrow, so I wouldn't count it until I actually see the.
Even if it's a contract?
Still, yeah.
Okay.
Who knows what happens in those periods? Yeah. Sorry, Andy.
Thanks. I have two questions. One was with regards to the UID part that you were discussing. So you said 3 years, under 3 years old, and the last point here is the deferral conversion of liabilities. So startups can still be 3 years old and more than 3 years old, and they're still kind of in the development phase. How does that get looked at? And then second part to this is oftentimes within a startup world, even the what you would call equity investors, they come in with a convertible loan note, which converts at some point of time. Are there kind of general guidelines around these 2 points?
So the first bit is very easy. If it's over 3 years old, it's subject to the test. And I appreciate that might not be ideal. I think Innovate UK appreciates that's not entirely ideal. And TAFTI, which is the European grouping of innovation agencies, have made representations to the Commission around that, which is considering it for the future iterations of GBA. So unfortunately, yes, you're subject to that test. It's just the way it is. In terms of convertibles, we've generally rolled those in, haven't we? It's my instinct. So we've looked at those within the definition of share premium or share capital. At least we have to date, and that seems to be acceptable within EU. What wouldn't be is directors' loans. Directors' loans wouldn't count towards the adjusted equity position. Sorry, there's.
On the same topic, I think you said this test applied at the point of commitment, and I was just wondering roughly what date that's likely to be for this current competition. Because in our case, that's quite critical.
How long's a piece of string? Before the 31st of March. Yeah, before the 31st of March. Right. If we get to initial indications of progressing or not progressing on the 1st of November, I think the fastest we've ever moved is about 4 to 5 weeks after that date. I mean, that's really motoring, but it's possible. Do you tip over on the 5th of November or something? Okay, that feels a bit more achievable.
Hi, my question's about the kind of commercial revenues test point again. If my product is going to be a platform that kind of changes what we do as a company from our kind of direct sales into a kind of a platform, obviously we're already making commercial sales directly, not through a platform, if you see what I mean. So how would you apply a commercial test, therefore, when we're kind of actually selling the same stuff but in a different way?
Okay, so it's commercial sales arising from the project. You're making other commercial sales, great. That feels like a better credit case to me. Yeah. I like.
But it's sometimes difficult to differentiate sort of between the two. It may not be perfectly clear when that kind of where that changeover takes place.
That's why we don't try and write an all-encompassing definition of that. That's why we sit down and have a conversation with you about what is genuinely a commercial sale and at which point are you fully exploiting the technology that you've developed through the project.
Okay, cool. Thank you for that.
Oh, Emily's got a couple at the back. Are these your questions, Emily, or online?
No, they're online. If we are crowdfunding at present, and this will conclude prior to your deadlines, part of which addresses the undertaking and difficulty test, does this work?
Yeah. Okay. Yeah, as long as you make it before we actually draw down the money, that's absolutely fine.
Okay, thanks. And the second question is there any indication on the expectation for a debt-to-equity percentage split for a pre-revenue business?
No. I would have thought we don't have a defined line on that. That's part of the detailed analysis conversation. So the real question there is the funding plan for the business credible? And is the timing of that right? And actually where the equity comes in versus where our debt comes in, what's the balance of that and the timing of that? It's not something we look to define. It's very easy to go into that bank system of, in this sector we want this and to be true, and if actually none of those things are true, then you don't get the deal. We're not in the same place as that. We want to do these things. We want to make them happen if they support the innovation. So we try not to be too black and white about those tests. So there's one here. So we did the one at the back first because Emily's faster than Nigel, and then we'll come to...
I was just wondering a little bit about the survey and using external agencies and the data, if people are adding to it, and the privacy and what happens to the data, and what's the relationship between Innovate UK and the external agency, going forward, and what happens.
I think that's our first ever GDPR question on these events. So the basic answer is Innovate UK Loans Limited as a separate SPV is registered as an information controller with the Information Commissioner's Office. We have a data sharing agreement with Innovate UK itself, so that the Part A application data and movement between us, there's a joint controller arrangement. The external stuff that goes through SurveyMonkey and Early Metrics, we've taken that through our internal IT board, and we've looked at the secure mechanisms for transfer. Essentially, each of SurveyMonkey, Airtable, which we're using around some of the output reporting from that, and Early Metrics are all GDPR compliant. Where the data may move outside the European Union for some of these things, I mean, SurveyMonkey is a US company. Where that happens, they are subject to the EU Privacy Data Shield. and all of the relevant arrangements are in place and have been signed off within the contractual terms on that. So essentially it's a closed system, and there's no other external use of those data points other than to inform our process, which is what you're signing up to.
So it's a unique arrangement between the external things in Innovate UK, and then it would never be used for another.
It can't be used for anything else.
Thank you.
Good question. I'm glad I wrote that paper now. Anything else? Oh, sorry, yeah.
Is this working? Yeah, no. I had a question around diversity and inclusiveness. Is that something that you track in your loans? Is it a metric that you follow in terms of, you know, who's taking up the innovation loans, what the profile looks like of the perhaps the founders of those startups with respect to diversity and inclusiveness?
So I guess it doesn't impact on credit judgment, but absolutely it's something that we are interested in the evaluation and outputs from that. Innovate UK obviously has its innovation, its women innovation piece. It has stuff that it tracks around diversity in business leadership and so on. It can't really be a credit consideration.
No.
So in some ways I might be the wrong person to answer this, but yeah, fundamentally we want to track those things. And actually I think we've seen so far some diversity. And so Richard's got his hand up. Do you want to make a contribution, Rich?
So I've just done the first round of the SQW survey this morning, and you haven't quite got it right, if I can say so. They asked.
Please do.
They started to ask about the makeup of our founders. We don't basically have founders, at which point there were no other diversity questions. So you might ask questions about the makeup of the management team as a more precise way to do that in future. I know Innovate are trying to track things like this, but handing it off to survey companies and not checking exactly what they're asking might not be giving you the data that you're trying to get out of it.
Yeah.
I agree it is very important to track that.
Yeah, absolutely. Thanks, Rich.
Another piece of work I did wrong. Whilst it's not something specific, it's not within the metrics or the KPIs for innovation loans because it's a pilot. I have looked at the makeup of the founders and or management teams of the 73, 74 businesses that we've lent to so far, and my guesstimate, because it's difficult sometimes to understand or to have information relating to diversity and inclusion, but my estimate is that we've got about 20% of the businesses that we're lending to have roughly diverse elements within their founding and or management teams. So I hope that gives you some sense as to where we are, and that probably is slightly ahead on overall Innovate UK. Not sure what the Innovate UK numbers are at the moment. I think we went from 14% of applicants were, certainly from a female to male point of view, we went from 14% through to I think 20-something%. So we're perhaps on a par with other Innovate UK activities. And there's more to go, because you're absolutely right. Diversity is really important for innovation, not just in terms of physical characteristics or indeed protected characteristics, but in terms of different ways of thinking.
So one of the points we had in Brighton yesterday was around diversity of approach, so certainly through creative industries approaching and tackling problems in other ways, and there's not being too hung up on the fact that, you know, it's a BA rather than a BSc, because, you know, there are different ways of addressing problems, and we can say that because we're 3 ARCS graduates in the credit team, in the credit committee, so none of us have got any science background at all, which is why we hand off the independent assessment around the technical and commercial stuff to people who really know what they're doing. But yeah, I mean, it's something, and I was involved in the creation of startup and delivery of startup loans as well, and it's something that actually you see benefits in your portfolio of having that diversity through the portfolio and broadening opportunities. Certainly, one of the challenges that we've been given by our strategic oversight committee is how do we reach out beyond Innovate UK's traditional group of businesses, those 11,000 projects that go round and 8,000 businesses that go round and round the circle. Let's get wider than that. Let's get out into markets that we don't normally reach. Anything else? Cool, I think over to you, Nigel.
Okay, thank you very much indeed, Scott. Right, wrapping up. We've only got about another 100 slides to go. We're pretty close. Key dates. Please, 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 if you have any interest at all in this competition, if you think an innovation loan might be right for you, please register. Costs you nothing. Do it. You'll get access then to Part A and the business financials, the project finance form, and please read the guidance, etc. Please make sure that you submit by midday at the absolute latest on the 18th of September. It's really, really important that you stick to that deadline. Just as a reminder, we're looking for information about your project and about your business. Project, Part A, the application form, 10 questions. There's a specific project finance form, information about your project finances, optional appendices. Please submit them in the format that's required. If you submit a 56-page, I don't know, something that's not a PDF, we won't look at it at all. And in fact, we have the right at that point to say this is an ineligible application, out it goes, and we never look at it again. What we typically do is if when people submit an application that's got an appendix that should be 2 pages of PDF and is actually 10, we will tell our assessors only to look at the first 2 pages, not to go into all 10. We're not that draconian. At least I'm not such an evil person that I would say gone because of that. We try to be a little bit flexible, but we do that at the risk of being unfair to those who've complied with the rules. So please comply with the rules. That application form, the appendices, the project finance form need to be uploaded to the FTP site by that noon deadline on the 18th of September. Also, you have to complete the Early Metrics Startup High Growth Index survey, information, questions about your business, those business challenges, your commercial opportunities, etc., the management team. And from the FTP site, you can get the spreadsheet that has the business financials, so your financial forecasts for the next up to 10 years, if that's how long your project is going to be. Those need to be completed, exported to PDF, and uploaded to that High Growth Index survey as part of your response to that survey. That, again, has to be completed by noon on the 18th of September. If you do both of those things, then you've submitted an application for an innovation loan that we're really keen to take a look at. We want to see great applications. We want to see businesses that we can help to succeed through this. And where are we going? We've, as I said at the very beginning, we found this extra £25 million down the back of the sofa. We could have used up to £5 million to fund some excess demand from the 5th competition in the pilot. We're probably not going to need all 5 of that, probably actually very little of that, maybe $1 million or so. So we've got about 20 to 24 million across 2 competitions, this one and the one we're going to do in September. We want to get it to at least 100 loans, because that will give us then better data from which to evaluate, notwithstanding my questions weren't drafted right, thanks Rich, to evaluate this program so that we can understand where it should go. We want to test price sensitivity of demand. We've deliberately changed the price in this extension of the pilot. We want to understand a different application process. It really is time, isn't it? And we want to get going on this. And I hope that what we will get is more businesses who are succeeding and sufficient data and evidence to enable us to put together a really solid business case to go to BEIS, to go to UKRI, BEIS and Treasury to say this should be a standard scaled up part of Innovate UK's way of supporting business-led innovation, because it drives the economic growth and it encourages people to get into the market, and it makes public sector funding work harder and go further. And please read the instructions. And if you are confused at all, please contact the customer support service team in Swindon. They are fantastic people. They love innovation loans. And I enjoy answering questions. and in the slides that will come out to you, we have the gory details, and there are lots of them. There's all about the eligibility, the dates, the process, how to fill in a form, what the questions are, blah, blah, blah. All of this stuff is in the slides that will come out to you, all about how you do your capital equipment usage, for example. Even a worked example, not necessarily with a helicopter, but there you go. All this stuff is all in the slides that are attached to this. I haven't just read out the answer, the instructions, because that's really boring. Hopefully you found this more useful. That was one of the slides I was meant to have read out, but Will said it for us. And that's what the business financials will look like. So not necessarily a spreadsheet from hell, but I say this without any apology. If you think that you want to borrow money over 10 years and you can't give us forecasts over 10 years, then I'm not inclined to lend you money over 10 years. So I'm interested in your forecasts. I know that they're forecasts. We know that they're forecasts. We're very interested in seeing that you've thought through the cash flows, that you've thought through whether actually a loan is right for you, and we'll look at the assumptions. And you know, one of the things we've seen is in relation to the extension period, we've seen quite a lot of people saying, yes, we absolutely need to have a 2-year extension period. And then we look at their cash flow forecasts, and yes, they're making an awful lot of very commercial revenues in that 2-year period. And when we go back to them and say, well, why do you need a 2-year extension period? They say, because I want 2 years of interest-free, interest only period. And we said, well, did you read the instructions? And they said, yeah, but I still want 2 years of interest only before repayments start. And we'll at that point say, well, maybe it should be a shorter period. The other thing that we've often seen is people who submit these projections and they're a classic hockey stick. And by the year 2025 or whatever, they are making oodles and oodles and oodles of money. And we say, well, why do you need the full 5 years of repayment period when you're making a shitload of money? Surely you could repay the loan earlier. And they say, either they say, oh, yeah, okay, we'll repay it earlier, or more often they say, oh no, we were going to reinvest all of that into the next even bigger thing. At which point we say, well, why didn't you put that in the forecasts? I'm really interested to see that your business is going to grow and that you're not just going to be sitting on squillions of cash, you're going to be investing it, at which point a 5-year repayment period may be a very, very sensible thing to do to help that business to grow. So those are the sorts of things to think about, and I'll stop hectoring you and just say apologies for running 5 minutes over, but thank you very much indeed for your participation, both online and here in the room. Online, thank you, goodbye, go grab a sandwich or an ice cream, and here we've got some lunch outside, and the team will be around and happy to have a chat. Thank you.